Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for your portfolio. Tracking early session volume here this morning, we're also going to be bringing you today's top market themes, plus elevating Yahoo Finance's most popular newsletter.
We certainly have a lot of ground to cover this Thursday morning. S&P and NASDAQ futures both rising to session highs after jobless claims rose in the final week of March, hitting the highest level that we've seen since January.
And we'll get more commentary on the path of monetary policy. That's coming from the central bank with a slew of Fed speak that's scheduled today. My goodness, they just can't shut up, including Philly Fed President Patrick Harker, Chicago President Austin Goolsbee, and Cleveland President Loretta Mester, among others. So let's get to it with the three things that you need to know, your roadmap for the trading day. We've got Yahoo Finance's Jared Blickery, Alexandra Canal, and Dan Halley here with more.
Stocks shoot for a winning day. Futures all in the green here as the S&P 500 snaps a two-day losing streak, ending Wednesday's session up more than 0.1%, bolstered by the Fed Chair Powell's assurances that we will see rate cuts this year.
If the economy evolves broadly as we expect, most FOMC participants see it as likely to be appropriate to begin lowering the policy rate at some point this year.
And we'll hear more from the central bank today with an all-star lineup of Fed speak from Philly Fed President Patrick Harker, Chicago Fed President Austin Goolsbee, and Cleveland President Loretta Mester, among others.
And Disney is successfully fending off a challenge from activist investor Nelson Peltz. About 75% of retail shareholders voted on Wednesday to keep Disney's current board intact. This represents a big win for the Magic Kingdom, ending months of uncertainty and distraction for CEO Bob Iger. But Disney faces an uphill battle as the company attempts to navigate consumers' shift away from cable and path towards more profitable, less profitable, I should say, streaming services.
And Apple is exploring the field of personal robotics, according to Bloomberg. The engineers at the company are looking into a robot that can follow users around their homes. The company is also reportedly developing a tabletop home device that uses robotics to move a display around. The efforts are in their early stages, but could represent a significant move after the company scrapped its long gestating electric vehicle project back in February.
All right, well, we have stock futures ticking higher this morning after jobless claims also moved to the upside. Investors digesting the latest commentary that we got out from the Fed yesterday. Chair Jay Powell saying in a speech once again that he still expects the central banks to lower rates this year. And let's take a look at some of the movement that we are seeing. Flipping it over to the futures and what we are seeing there. We are right around the highs here of the session for the futures. That came after that jobless claims number was released. You got the S&P futures up just about 0.6% on track to open the day higher, as well as the NASDAQ. And taking a look at where we ended the day yesterday, we did see gains on the screen for the S&P, just about a move to the higher, about 0.1%. The NASDAQ closed up yesterday 0.2%. So it looks like we could be adding to those gains here today, Brad.
I want to take a look at gold here. That's been all the rage. All the ads that you've got in your Instagram feed probably have some type of gold ad right now. Anyway, let's take a look at gold futures as of this point in time. You're seeing a little bit of slippage, but look at this number, 2,300. We're still hovering above that. Of course, that's off of the highs that we've seen over the course of this 52-week range, but you'll notice just how close those highs are on the 52-week to what we've seen over the day and ultimately here on the past 24 hours, as well as that is striking some of those new highs. We'll see if we can continue to power through those and what the catalyst will be. Let's also take a brief look at oil. There you're seeing a little bit of slippage here on the day. That's not an oil joke. That's just a technological term here on the markets. WTI, you're seeing that down by about 0.2%, and Brent crude, you're seeing that down by about 0.1% right now. We're also tracking all things Disney. Disney came out on top in its high-profile battle against activist investor Nelson Peltz, ending months of uncertainty over who will sit on Walt Disney's board. The entertainment giant saying Wednesday at its annual shareholder meeting that the current Disney board will remain intact. After 75% of retail shareholders, they voted in favor of Disney's current board, according to a source familiar with the situation. For more, we're joined by Doug Creutz, who is the TD Cowen, Managing Director and Senior Research Analyst covering the media and entertainment landscape, and Yahoo Finance Senior Reporter Alexandra Canal. Doug, great to have you here with us this morning. First and foremost, just want to get your reaction. Are you at all surprised by what we saw?
No, I would have been shocked had Peltz or Blackwell's won. I think they just didn't have a lot of vote. They had to convince an awful lot of shareholders to go with them. And I think, while they identified some things that Disney had maybe mishandled in the past, I don't think they had much in the way of a plan for the future that was particularly interesting. So no, I'm not surprised by this at all.
All right, so Doug, here we are today. What happens then next for Iger? We talk about what his priorities should be, obviously stemming some of the losses that we've seen within the streaming business. But from your perspective, what should be number one on his plate?
Well, from my perspective, I think Disney ought to be leading the charge to rebundle all the disparate direct consumer services out there together. I think that's the biggest issue that the industry faces, is that by leaving the bundle behind and going direct to consumer, you've created a lot of overhead, additional costs that didn't exist before, both in terms of acquiring users and also in terms of having to over-program your service relative to what programming you needed in the bundle before. I think that's the direction they should be going. We saw a little bit of that with the streaming JV, the sports JV they announced with Warner and with Fox. I thought that was a good sign. But it's a long way from getting back to a bundled product, which, by the way, I think in the long run will be better for consumers. It was great when you could pay $7 a month to get tons of programming and no advertising, but now increasingly these services are raising price aggressively, asking consumers to watch advertising. You're seeing major sporting events. The NFL playoff game recently was exclusively through a streaming product. A lot of consumers weren't happy about that. So I think getting back to a bundled product will help the industry and ultimately be better for consumers. I don't know that he views that as a priority, but I think that's what it should be.
And Doug, another big priority of Disney is succession planning. And that was a big thing, a big conversation amid these proxy battles. When it comes to the board moving forward, how much more pressure are they going to face post-proxy battle? Because this was very high profile. I would assume that now a lot more eyes are on this board to really deliver returns for Disney.
Yeah, look, they've been trying to figure out how to replace Iger for 10 years, literally. They thought they had a replacement in Bob Chapek, but he turned out not to be the guy. It's still not clear that there's somebody internally that's ready to step into the job. And I think to try and get someone externally is very risky, given that Disney has a very strong and unique culture. An external candidate might be a bad fit for that. So there is a lot of pressure on the board to find a successor to Iger. I think there was before Peltz raised his hand. I think there is after Peltz has moved on. And that is something that I think investors, I think right now, 2026 still seems like it's far away. So if you're investors, you're sort of looking at the optimistic outlook for earnings this year and some of the things Disney announced on their last call, like the sports JV, and can be excited about that. But as you get closer to 2026, that's going to be more and more of an overhang on shares.
What is the likelihood that we see Disney able to attain some of the goals that Trian has set forward that have now been made very public here, and that investors are still going to hold them to?
Well, I think the one that stands out was the idea that their streaming service should be at 20% operating margins, and it's currently losing money. The funny thing was, Trian's analysis suggested that was a cost side problem. But if you look at Disney's cost per subscriber today, it's almost identical to Netflix. The issue is that Disney's revenue subscriber is like 30-something% below what Netflix is generating. Some of that's because Netflix has been around longer and they've been raising price for longer. And I think it's also just has to do with differences between Disney's service and Netflix's service and who the target market is. I don't know that that's a reasonable goal anytime soon, unless they decide they're going to raise price by 50%. Even then, though, you might lose a lot of subs, and that's a risk too. So I think investors don't expect 20% operating margins from the streaming service overnight, but they do expect meaningful progress to that goal. And I don't know that by 2026, Disney's going to, they'll be profitable by that point, but I don't know that they're going to be significantly profitable by that point.
Doug, do you expect more activists to circle this company moving forward? And what happens with Peltz? Do you think he just magically goes away?
I don't. I mean, it's very hard if you're an activist to get a company like Disney, who's got a $200 billion market cap, to move. You have to, in order to own enough shares to make voting against the board a really credible threat. You have to buy a lot of stock, and that's very risky. Disney's a creative content company. They don't just make widgets, right? It's not just a question of raw sort of efficiency. And Disney obviously has identified that their creative output over the last few years has been substandard for them, and Iger's trying to address that. And I think he'll have at least some success. So no, I don't think you're going to see other activists get involved here, especially after this sort of resounding defeat. As for what Peltz does, I don't know. Maybe he just sells his stock and walks away and declares victory, because he has made a lot of money off of investment. The stock has gone up a lot in the last several months, in part because Disney has reported some good news. And he might have lost the vote, but if you make money, then that's still okay.
All right, we want to switch gears here because Paramount is in exclusive merger talks with production company Skydance. This is according to the latest reports here from the Journal. Now, the entertainment giant is also pausing any conversations with other bidders for 30 days while it does work out a potential deal with Skydance, and this coming after private equity firm Apollo Global Management offered to buy the entire company for $26 billion on a Sunday. Let's talk about how likely it's going to be that Skydance will be one of those, or be the one out of all these bidders to acquire Paramount. Doug, my question to you, if this is the case, do you think this is a good move for Paramount? How are you looking at this from an analyst perspective? And just regarding the interest that we've seen in Paramount, what does that then tell us more broadly about the media landscape right now?
$26 billion, and I mean, again, this has been reported, but there's a lot of times there's devil in the details that you don't know what they are. But $26 billion for Paramount would be a very significant premium to the current stock price. Once you take out the net debt sitting on their balance sheet, it values the stock in something in the 20s, and the stock's at $13 or whatever it's trading at right now. Like, that's a big premium. That's hard for a board to turn down. Now, maybe Skydance is potentially offering more. It's complicated by the fact that, right, there's the Paramount stock. There's also NAI, which has a controlling voting interest in Paramount, which could be bought for significantly less. A purchase of NAI would allow somebody to control Paramount, wouldn't necessarily help current Paramount shareholders. So, it depends on exactly what the discussions are that are going on, whether they involve just NAI or the Paramount shares. As far as what it means, look, there have always been people with lots of money who want to be part of Hollywood. And sometimes they can be a bit price insensitive because owning a Hollywood asset is very glamorous. And you may be seeing that at work again here. I'm not sure. I think it's hard to make a business case right now for why Paramount should be worth $26 billion. Not impossible, obviously, but it requires you to make some pretty aggressive assumptions about improved earnings in the future. So, we'll see how this plays out. There's been a lot of chatter about Paramount for a while now. And, things keep not happening. And until something actually happens, I think that's probably the default expectation, is that somehow these talks will break down and nothing will happen. But if something does happen, it wouldn't necessarily surprise me.
Doug, thanks so much for taking the time here today. We got to leave things there. Doug Kreutz, who is the TD Cowen Managing Director and Senior Research Analyst covering the media and entertainment landscape, and our very own Ali Kanal joining us this morning.
Thank you.
Certainly. Well, Apple's next big bet is straight out of a sci-fi film. Bloomberg reporting the iPhone maker is considering a push into the field of personal robotics. This could mean a robot in your home. Efforts are said to be in the beginning stages, but it could represent a meaningful shift after Apple abandoned a costly electric vehicle project back in February. And it comes as Apple faces mounting challenges, slowing China demand, regulatory battles, and playing the AI catch-up game, just a few of those that analysts and investors are tracking. Apple is off more than 10% this year. Here with more, we've got Yahoo Finance's tech designated hitter, DH, Dan Halley, all the DHs. Anyway, Dan, give us the top line takeaway here.
I'm going to be joining the Mets, and I'll be their best player right away.
There we go.
I mean, they're terrible, God. I mean, this is a big deal, right? The idea that they're getting into or exploring the idea of home robotics is a major step in a different direction. They were originally going for the car. Obviously, after a decade of work, they kind of put the kibosh on that. They still never came out and said they were working on one, but there were obviously tons of reports. But now this report that they're getting into home robotics, I mean, it seems more attainable for a company like Apple to do this rather than get into an entirely new industry like automotive. So I think one of the takeaways here is there are other robots on the market. Obviously there's Roomba. Everybody knows about Roomba. My cats hate it. There's also Amazon and its Astra, which is kind of this weird at-home robot / Sentry that can navigate around your house, and you can give it cans of soda to navigate around your home to give to someone else. But it's not exactly a huge product that's going crazy on the market. So I think for Apple to get into this, it's going to have to pitch this as a must-have. And I would have said that I didn't think a smartphone would have been a must-have when they first introduced it, but at this point, I don't see how an at-home robot is a must-get.
Yeah, Dan, does this come as a surprise to you, or is this maybe a move that could make sense in the long run?
To me, it comes as a surprise just because it's such a niche product, right? It's not like, when Apple rolled out the Apple Watch, for instance, right, there had been products out there. It was a proven market, right? When they came out with the AirPods, it was a proven market. I think one of the things about this is it's not a proven market. And sure, Apple is going to get into markets that aren't necessarily built out yet. They want to be perhaps take first mover advantage, but that's not really their MO at all. They wait to know that there's something going in the market that people want. And so getting into the personal robotics space, again, this is still reported. They haven't said anything. It's also, people mess with products all the time. We've been talking about foldable iPhones forever, so this may never even hit the market. But I think it's worth pointing out that it's not exactly Apple's move to do something before others. And for Astro to be, just a niche product that is expensive and not many people seem to want, I don't know if Apple's actually going to go all the way with this.
Yeah, and then questions of what does it look like, Dan? Does it look like a Nightscope? Is it more akin to an Optimus from Tesla? Ooh. Questions people have answers, or people want answers to.
Johnny 5. I want Johnny 5.
Johnny 5. Anyway, interesting. Dan, thanks so much for breaking this down with us. Appreciate it. All right, Shauna, what's on tap for the rest of the day here? Get us up to speed.
Well, we are just getting started here on Morning Brief. Lots to come, and all day here at Yahoo Finance. First up, Wall Street's bearish tone on Tesla. Well, it's ramping up after the company reported a massive miss on deliveries earlier this week. We are going to be speaking with one analyst who says now's the time to sell the stock. Plus, Amazon's big bet on AI. The company spent $2.7 billion to back a startup, Anthropic, earlier this month. We're going to be joined by an executive from Amazon later in the show to dig deeper into the AI race. And later in our brand new show, Wealth, anchored by our one and only Brad Smith. It's crunch time for taxes, but don't worry, Brad is here to help. He's going to bring you all the tips, the tricks, the checklist for any of your last-minute tax filing needs. Keep right here on Yahoo Finance. We'll be right back.
Ford shares, ticker symbol F, moving to the upside today. This comes after the Detroit automaker postponed production of its large electric SUV to 2027. It was originally scheduled for 2025 here. Now Ford's saying it's going to continue to invest in EVs, but saying it's delaying to allow for the markets to mature here. What we're going to see from the auto manufacturers in this near-term period of time is a critical decision. Do you postpone this manufacturing, such as Ford is coming out and saying, or do you try to enter into a marketing blitz of demand generation, which can be very costly? A lot of companies probably don't want to do that, especially if they're already trying to figure out how to reallocate resources in their manufacturing hubs and still trying to figure out what headcount is necessary coming off of the back of some critical labor negotiations that played out at the tail end of last year. Much of that negotiation really trying to account for where the demand cycle is at right now and where they're going to need to get ahead of consumers' ability and willingness to purchase EVs as well.
Yeah, I think you're exactly right, Brad. When you read news like this, it all points back to the demand, lackluster demand that we've seen not only for Ford EVs, but really what we've seen across the entire landscape. It's a problem that Ford and its rivals are all struggling with at this time. And in this report, they pointed directly to price. We know pricing has really been an issue when it comes to EVs, especially at this time when you take a step back and take a look at the macroeconomic environment, the higher for longer interest rate environment that we are in right now. People simply are not spending as much as they previously were on some of those larger purchases because of the interest rate environment. So things like EVs obviously taking a huge hit, and Ford saying that they're looking to address some of the pricing issues here. They're saying that they want to lower the cost of the EV by utilizing, quote, emerging battery technology. So by delaying this larger SUV EV debut here by 2 years, maybe they will in turn be able to lower the price just a bit. We know the pricing wars that has played out across the EV landscape, nearly every single automaker within the industry being forced to lower their prices in order to remain competitive. So this move here from Ford, Brad, is just the latest when it comes to delaying some of their EV plans, pushing it out because of the fact that demand just simply is not at levels which they initially expected it to be at this time.
Yeah, and that's not just the vehicle that they have to get right. It's also the consumer's relationship with how they're charging, how they're making sure that the tire wear. I love to come back to this study that J.D. Power did. A lot of EV owners were uninformed of the faster tire wear. That's specifically important when you're hauling big things, and you've got those pickup trucks here anyway. So Ford, we'll see how they adjust. And
all about the tire wear for Brad.
Look, it's
they got to work on that before they win over your business.
Can't drive on nubs.
Guys, let's take a look at one of the reads here on the consumer, and that is Levi's. And take a look at that move. Shares up nearly 14% in the pre-market. Shares moving higher after the company beat the street's expectations on both the top and bottom line. Now, that beat was driven by a jump that we saw in margins amid its cost-cutting efforts. We've talked to the CFO about those cost-cutting efforts over the last several quarters. The company also raising its fiscal 2024 guidance. That's a big reason why we're seeing this huge jump here in the pre-market. But when it comes to these results, the street also very optimistic about what they are hearing from Levi's. Morgan Stanley, one of the analysts, that team out saying that management stood out positively, especially when you compare it to some of the disappointing or lackluster results that we got from some of Levi's peers, namely PVH. So cost cutting really starting to take hold. Productivity planning, that's all starting to pay off at this point, and we're seeing the fruits of that labor, obviously, in that upward guidance that we're getting from Levi's.
Well, yeah, really interesting, at least in the most recent quarter. The net revenue is ultimately 8% lower, and you look at some of the areas, the segments of this business geographically, America's net revenues down 11%. You also saw in Europe, net revenues decrease 7%. All of this considered here, you got to think about where they're going to be able to pull some levers and see strength, and it might be Asia. Asia net revenues, they were in line with the prior year, but it's a large question of how much they can capitalize on the 22% growth in the prior year that they had already seen. I don't know what the jean replenishment rate is. I know that the CEO of Levi's historically has said he doesn't wash his jeans, so we'll see what the new incoming CEO as well.
Do you wash your jeans?
I think you're supposed to after a certain amount of time. Look, I don't want to
say if you don't wash your jeans because you're a jean wearer, I'm going to be
I do wear
pulling you off
jeans.
this- okay.
I am a jean wearer, indeed.
Wear a
I will
jean
accept that
washer,
hat
too.
and title, and yeah, that descriptive. Yes, and a jean watcher. Yes, I can safely say that as well. But anyway, before this goes too off the rails, wholesale net revenues. This is an important one for investors. Really key in on hear what the company has to say about it. Those wholesale net revenues actually declined by about 18% here. So that's going to be part of the shift that we're going to be waiting to hear from the CFO. And for a deeper dive into the company's results, tune in to our live interview. You see how I did that? The Levi CFO, Harmeet Singh, joins tomorrow at 10:30 a.m. Eastern Time. You do not want to miss that conversation. Good friend of the show here. We'll see what he has to say. We're also just minutes away from the opening bell on Wall Street. We'll be watching the day's biggest market movers and speaking with a strategist on how to position your portfolio for a higher for longer environment. That's right after the break. Bing bong. All right, that's the opening bell on Wall Street and in Midtown Manhattan at the NASDAQ, where they're getting cloudy with it. 5-9 ringing the opening bell there. Ooh, Barbiecore still in vogue, I guess, here. DXYZ is the ticker symbol that's ringing the opening bell at the New York Stock Exchange. Ooh, funfetti. Never get tired of it. All right.
Brad, let's take a look at where Barbiecore is always in vogue.
Is it?
Right? Yeah. Well, these days it is at least. All right, let's take a look at where things are opening here because we are seeing a move here. It looks like on track to open to the upside with the NASDAQ opening up just about 0.2%. Taking a look at that 4-day chart, though, the moves that we have seen since the start of the week, we certainly did decline Monday and Tuesday. A bit of a rebound yesterday, at least on an intraday basis here. We're opening to the upside. You've got the S&P also regaining some of the momentum that it lost earlier this week, up just nearly nearly 1% here at the open. And rounding it out with the Dow, that movement to the upside here at the open, up just about 250 points. So again, a huge move to the upside on 4-day basis, though still in negative territory. Also, let's take a look at some of the movement that we're seeing sector-wise, and still a bit, oh, look at that, all green on the screen here this morning. We were just right around the flat line with energy earlier, but we have energy up just about 0.3%. Real estate and technology leading the way there, Brad.
That's right. All right, so we've got green across the screen. So let's keep the good times rolling. We're continuing our coverage of the opening bell. Let's go to Yahoo Finance's very own Jared Blickery. After a record-breaking week for gold, Jared, what are you watching in the commodity space right now?
Oh, thank you, Brad. I'm watching gold with a new nominal high, but backing off of that high for a little bit. I'm looking for the GC=F ticker. The squares are jumping around quickly, so bear with me. Let's see if we can get it. That is not corn futures, and we are playing a game of whack-a-mole here. Here's gold futures finally. You can see this was actually a record overnight. Here's a year to date. Now, basically, gold had been stuck in a trading range. In fact, I'll show you a 3-year chart, and it finally broke out. Classic breakout from a long trading range says there should be more momentum. Now, what's impressive to me is that this has happened against the backdrop of a declining dollar over the last few days, and over a strengthening dollar over the last few months. Now, over the last few days, the dollar has backed off those highs, and I'm going to pull up a chart of the DXY for you. Here is the U.S. dollar index. It's been trending down this week, but I did mention it had been rising recently. This is a trend for the year. You can see just pulling off of a potential double top here. So why I bring the dollar up, if the dollar continues to move to the downside as it looks like it wants to continue this pattern, that should be an additional catalyst for gold. And also got to mention crude oil. Crude oil has been holding above $85 per barrel. And I don't know if I'm going to be able to get you a quote here. Here is a quote on WTI crude. It is 85.36. So got to keep an eye on oil as well, guys.
All right, Jared, thanks so much for keeping an eye on that. Certainly interesting moves here that we are seeing. Let's take a look at the major averages because, again, we are moving to the upside. The S&P up just about 0.7% yesterday, coming off the fact that it snapped its 2-day losing streak. Now, investors are looking ahead to the jobs data that we're going to get out tomorrow, the big jobs report. We got jobless claims out this morning, which rose here, the highest level that we've seen since January. We're also getting commentary out from Fed officials this week, tamping and fanning rate cut hopes here. So most recently, we have Fed President Jay Powell. He's reiterating the fact that they are letting the data guide the next steps. Let's take a listen.
We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%. Given the strength of the economy and progress on inflation so far, we have time to let the incoming data guide our decisions on policy.
All right, for how investors should position themselves while the path to rate cuts stays a bit murky, we want to bring in Max Kettner. He's HSBC's chief multi-asset strategist. Is here, Max. It's great to see you here. So lots to digest there. We ran through a lot in the intro, but your perspective right now on the markets, lots of focus on the jobs print that we are going to get out tomorrow morning. But what do you think that's going to signal just in terms of the Fed's likelihood that we will see a rate cut in June?
Yeah, good morning, and thanks for having me. I think, to be honest, I've been listening to you guys for the last 10, 15 minutes. I think probably the most interesting you guys have been talking about is whether I should wash my jeans or not. And that leads me to a whole other, struggle in my life right now.
You're stepping on toes this morning, Max.
My washing machine again, But perhaps, a little bit about markets. When we look at, at the Fed right now, I think it's quite clear that they've gone away from, think about Powell 2 years ago saying, lowering inflation will require pain. It is what it is. It will require pain to bring inflation really down sustainably. And that's really moved towards bringing down inflation down now actually requires time. No longer the pain. It no longer really requires, bringing the economy down or perhaps really bringing us into a recession. No, that's not required anymore, but it will require some patience. So might we see, perhaps the Fed guiding us to less than 3 rate hikes? That's surely a possibility. Our forecast is still for 3 rate cuts by the Fed, yes, but there might be a possibility that, of course, the Fed says, you know what, we might be cutting in June, but if the data then is too strong, particularly around sort of the turn of the year where perhaps inflation is stuck or might be reaccelerating again, That then is a bit tricky, I think, for the Fed to continue cutting pretty aggressively. But I think overall for the market, that need not be bad news, because let's remember, why are they saying that? Why are they doing it? They're doing it because they can, because the economy and the data is just really, really solid. And if anything, re-accelerating.
What do you expect the data to tell us? I mean, this has been a huge week for some of the labor market data. If we get to Friday, we get another hot reading, what does that do for the Fed's tenor?
Yeah, I think, look, to the Fed, I think the more important thing really is what's going on with wage growth right now, right? It's not really important whether NFPs will be at 200 or 250 or 300. As long as wage growth doesn't print at like 0.4, 0.5 month on month for a couple of months, I think they're fine with that. In fact, they probably can, they can sort of tap themselves on the shoulder and say, great, well done. We've landed the plane, right? Now the labor market is still pretty strong. It's no longer as ridiculously booming as it was perhaps 9 to 12 months ago. The unemployment rate has ticked up a bit. Job openings have gone down a bit. So there has been some normalization, but clearly without really significant pain. So they can sort of, they can really tap themselves on the shoulder and say, hey, look, we're bringing inflation down, wage growth not really re-accelerating, but in terms of the labor market strength, that's still there. So we didn't actually destroy anything. So I don't think the labor market data per se, whether that's jobless claims, ADP, or job openings, or non-farm payrolls, I don't think that's too crucial, as long as really wage growth doesn't go the wrong direction.
Max, when you take a look at the run-up that we've seen in commodity prices during all this, we have oil moving to the upside, you have gold hitting the highest levels that we've seen in quite some time, record highs there. Is there a buying opportunity still within the commodity space? And how much more, I guess, how complicated do you see maybe this run-up in oil making the Fed's playbook here, making the job tougher for the Fed to tame inflation?
Yeah, not quite yet, right? On the oil side, yes, there will be we will be moving from disinflationary effects from energy prices to inflationary effects, but they're not going to be crazily inflationary, right? It's not like, let's say, how we switched from 2020 to 2021, right? Where we went from massive, almost like minus 60% year-over-year base effects and inflation, and we went all the way to like, I think it was at some point 150, 200% year-over-year plus. That's not going to be, we're sort of moving from minus 20 to plus 20, which, yes, at the margin, not great, but it's not going to move the needle that much, right? I think overall, we're still really bullish on energy, still bullish on oil. Bear in mind, positioning is still pretty low. It's just started to rise from a multi-decade low, the positioning from asset managers. When we look at other things, let's say, jet fuel demand, right? So things like intentions to travel are still really strong. So therefore, jet fuel demand should also still be pretty high. So a lot of things are still, I think, speaking in favor of oil. But overall, it's not going to derail the risk asset picture overall, because let's face it, it doesn't really matter that much whether the Fed will cut 2 or 3 or 4 times, as long as they start cutting this year. That's the really crucial thing. As long as they start cutting and saying, look, we are on a rate cut path, but it might just take a bit more time, that's enough for risk assets, I think, to get a bit of a relief rally.
Max, we only got about 30 seconds left here. Does a less cuts than expected reality trigger any type of portfolio repositioning from your perspective?
No, I don't think so, because what we've seen is really, let's say, compare it with September, October last year. We had a bond supply shock. We had inflation moving the wrong way. We had the Fed suddenly signaling a December hike, and the S&P went down peak to trough, not even 10%, right? So now we are not really having these shocks, and we've got better growth. So I don't, other than a couple of percent of a setback in equities, perhaps, a handful of basis points and high yielding credit spreads, fine. But those are the dips that you really want to get back into.
Max, always a pleasure kicking off the trading session with you. Thanks so much for joining us this morning. Max Kettner, HSBC Chief Multi-Asset Strategist. Tweet to us or X-post to us how you're washing your dreams, what kind of detergent you're wearing, and we'll get that out to the good people as well, Max. Thanks. Appreciate it. Well, today's stock to watch, Conagra Brands, climbing higher in pre-market trading and now during the trading session by about 4% after topping Wall Street estimates for both profits and revenue in its third quarter. The maker of Slim Jim and Duncan Hines, saying that it saw improvement in its margins thanks to cost cutting and increased consumer demand. More people tapping into a Slim Jim out there, I guess.
I guess so, and they're tapping into the sweet tooth with Duncan Hines. But let's talk about some of the numbers that we saw within this space, because yes, volumes did improve, especially when you compare it on a quarter-to-quarter basis, but they did still decline, though, from year-ago levels. You're looking at a decline of just over 1%, better than what we saw, the 3% drop the previous quarter, but still moving to the downside here, falling actually about 1.8%. Management, though, did boost its annual profit margin forecast. Grocery and snack sales did rise about 3%, so they are seeing some improving trends within their business. It's another read on the consumer, at least as you take a look at how Wall Street's reading this beat here, enough for the street, and we're seeing shares rise just about 4%, Brad.
Yeah, really interesting here on the outlook as well. The company increased their adjusted operating margin guidance to approximately 15.8%. Perhaps some of the investors really looking through to that and exactly where that lines up in the reaffirmation of their full fiscal year 2024 guidance as well. So the margins coming in perhaps a little bit better than expected, and no doubt the shares reacting positively. I know Slim Jim has a really good social media account, so dare I say anything bad about Slim Jim, but I will say it's not my favorite. All right,
really?
Coming up, we're going to be it's a good snack. It's a good snack. Not my favorite, though. We'll be digging through the latest news out of the EV space, from BYD to Tesla, as both continue to make moves to stay ahead of the competition. That's after the break. Wall Street getting more bearish on Tesla after a rough start to the second quarter. A number of analysts cut their price targets this week after the company reported disappointing first quarter delivery numbers. Guggenheim reiterated its sell rating and lowered the price target on the stock to $122 from the previous $132. Let's bring in Ronald Yepsico, who is the Guggenheim Securities Director of Automotive Equity Research, to discuss more. Ronald, take us into your thesis here. I mean, you're looking at a few things. The delivery downside in this quarter, saying it's a function of demand and not supply here. What is the demand profile that you're seeing in this environment as a lot of customers seem to be wavering here on their purchase intent?
Absolutely. I would say mostly a function of demand. There obviously were supply issues, we think, on the Model 3 in the U.S., but most of the downside this quarter relative to both year over year and the fourth quarter of last year was driven by demand. We think U.S. volumes were down something in the range of 20 to 25%. We don't get that number in the release, but we're able to back into it from other regional data. And I think, understandably, it was a very messy first quarter. U.S. EV demand slowing. China competition is quite strong, both BYD, Xiaomi, Huawei, which operates through the Aito brand. But and then Europe really hasn't grown for 5 quarters now for Tesla. So I think structurally there are kind of emerging risks in all 3 regions that even as we move beyond what is a very, very messy first quarter, I think, earnings result, there's reason to be concerned kind of for the structural midterm and long term.
Ronald, given the structural risk that you just laid out, specifically what we're seeing play out in China right now, obviously the price war is going on, increased competition. Now we have Xiaomi entering the race as well. What is your outlook for Tesla in China at this point?
Yeah, we struggle to forecast growth this year in terms of units. I would say at a high level, BYD entering the market, let's say 2 years ago in terms of meaningful volumes, that has been an issue for Tesla in terms of trading down. Now what you have is much more competition directly with Tesla's Model 3 and Model Y in China, both from Huawei, who operates under the Aito brand. They sold nearly as many SUVs as Tesla sold Model Ys in China in the first quarter at very similar prices. And now you referenced the Xiaomi car. I think if you compare specs and price point for Xiaomi's SU7 vehicle that just launched in China, I think that's going to be a serious competitive threat to the Model 3. And obviously, as we look beyond this quarter and this year, Xiaomi's not going to stop with just a Model 3 competitor. They will eventually launch an SUV. And they view this market as kind of tangential for them to their broader consumer electronics business. So it is almost a loss leader product on the front end, which is tougher competitively, I think, for Tesla.
Ronald, if we find ourselves in maybe an EV winter here, and I'm kind of using the analogy of what a lot of crypto people think about as well. If we find ourselves in an EV winter, does that mean Tesla, other automakers say, you know what, we spend further to build out what is going to be the future 5-10 years from now? And I'm thinking specifically about this multi-billion-dollar EV factory in India that Tesla is thinking about and apparently trying to kick the tires on where they could potentially break ground there. Can that offset, or is this a new era of investment that they initiate in order to just get ahead of that next cycle of demand?
Yeah, it's a good question. I think for Tesla specifically, a little surprised by the India factory kind of rumors, for lack of a better term. Once Giga Mexico is built, Tesla's supply is already outpacing demand. I think once you add Giga Mexico onto that, the supply is still going to exceed demand. So I'm not really sure why Tesla needs another factory in the near or medium term. I guess if this is a very long-term initiative, then that makes sense. But I would be personally, I think, surprised by anything in the near term about a factory in India actually becoming more concrete.
Ronald, what's it going to take for the pendulum to swing back in favor of Tesla and the other EV automakers?
Yeah, I mean, the biggest near-term risk we've highlighted to our bear thesis, so that would be an upside risk, is the FSD trial that Tesla has announced. I think there's the potential, particularly for narratives, to run away from themselves, to get away from themselves, and to have volumes, take rates for FSD to expand post the trial period. What we have messaged is that even if take rates do expand for FSD, it's likely to be very modest. It's a $200 connected service. Historically, connected services in automotive do not sell very well. And Tesla themselves has said monthly payments are an issue to electric vehicle adoption currently. If we were to take them at their word for that is the primary bottleneck, adding another $200 on the cost of a vehicle every month would seem to be prohibitive. So I don't think we're going to see meaningful take rates for FSD in the near term.
All right, Ronald, always great to get your perspective. Thanks so much for joining us here this morning. Ronald Yesico, he is Guggenheim Securities Director of Automotive Equity Research. Thanks so much for joining us.
Thank you.
Keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back. Housing playing an outsized role in the Fed's challenge to bring down inflation. There's a Wells Fargo report out that took a deep dive into the gap that we've seen between core PCE and core CPI. Here to explain Yahoo Finance's Miles Udland. Miles, you wrote about this in our morning brief earlier this week. Just talk to us about the discrepancy that we're seeing and this outsized role, as you put it, that housing is now playing in the Fed's fight to tame inflation.
Yeah, so if we look at that first chart of the gap between core PCE and core CPI, 1 percentage point is the gap right now. Historically, the gap's been about 0.3%, PCE on the lower side. So CPI in general has been a little bit higher, hotter, however you want to say it, but by a significantly smaller margin than we currently see. Now, everybody knows housing costs are a big driver of inflation overall. The BLS called out in its last CPI report that housing costs were over 2/3 of the annual increase in CPI we saw, and that's really creating this problem for the Fed where core CPI is still at 3.8%, almost double their target. Now, core PCE is running at 2.8% year over year, above the 2% target, but closer to there. And if we saw that chart where you see the share that housing plays in each measure, over 40% of core CPI is housing costs, up 5.9% year over year. Just 17.5% of PCE is housing costs, which are up 5.8% a year in that measurement. And so while the Fed cares about PCE and they will say they're focused on that measure, it's going to be challenging, and it is challenging at this point for the Fed to make this argument for needing to cut rates with the more popular inflation measure, CPI, still at 3.8%, even when, trimmed down for the Fed's preferred way to look at it. So, they are confident. Everyone's confident. Housing costs, it's kind of a lag, yada yada. Been through the whole rent story, all this, that, the other. But that gap is a major challenge. That measurement issue is a major challenge for the Fed in trying to communicate why they need to cut rates.
Yeah, you mentioned rent. There was a study out, I think it was published this morning by apartment.com. National average annual asking rent rose by about 0.7% in March compared to 0.8% the prior 2 months. So that's still going higher. Yeah. This entire housing picture, though, how much can the Fed, what levers can they really pull to influence it in the near term?
Well, it's interesting because I wrote this earlier this week. 2 weeks ago, I wrote how the Fed does not care about the housing market, because Powell also said that at his press conference back in January, where he was asked explicitly that question. And he said, we don't target housing policy or any rate of housing inflation or anything like this. And so, the Fed wants to walk this very narrow path of it has a dual mandate to look at inflation, to look at employment, and things that are related to that, of which obviously housing, wages are parts of it. They will accept and they will tell you point blank, that's not something that we know we can control. They obviously monitor it, but what housing prices do, what the stock market does, is not necessarily going to be a motivator to Powell.
And how much is it, real quick, because we only have 30 seconds, but it's not just housing, right? And you pointed that out. When you take a look at some of the other data points that we've gotten out, specifically manufacturing data, like you referenced in your piece, showing that inflation here, they're battling a lot of battles.
So the problem with inflation, and we do not have 30 seconds to do this, but Brad referenced it, right? We are on a huge lag for apartment rents specifically being the main driver here. Everyone's been waiting for them to bring down overall inflation. In that interim period, the economy has accelerated, as we talk about on this show every day, and that's bringing in this risk of, while housing comes to where you want it to be for the Fed to meet its goal, other parts of the economy get on firmer footing and inflation re-accelerates. Again, good for growth, people are happy with that, but for a Fed trying to get inflation all the way back to 2%, it's a major hurdle.
All right, Miles, always great to have you on set.
That was 30 seconds, by the way.
I think 57:30 is where we need to get out, so, we're all right.
All right, Miles, thanks so much for having on set with us. All right, Brad, it's time for you to go, but before we say our farewell, tell us what's coming up.
Bye. All right. Well, of course, today, which camera? Today is all about protecting your finances. We will be breaking down all of the common mistakes that people make on their tax returns and how you can avoid them. And with both the men's and women's Final Fours coming up this weekend, we will be giving out some tips on how to have fun with some sports betting without burning a hole in your wallet.
But don't step away, because when we come back, Madison Mills is going to be joining me at the desk. We will be covering the latest on Fed speak here from Chair Jay Powell following his dovish comments yesterday. Plus, our very own Dan Halley is going to be speaking with an Amazon executive about their newest investments and also developments within the AI space. Don't go anywhere. Welcome back to Yahoo Finance. I'm Shauna Smith alongside Madison Mills. We're just about 30 minutes into the trading day. We certainly have a busy hour ahead of us. Let's take a look at the markets and where we are right now. We're seeing green across the screen still, with the Dow up just around 156 points. So off the highs that we saw shortly after the open here on the session. We got the S&P up just about 0.7%. The NASDAQ up nearly 1%. And a lot of that, Maddie, what's driving the markets here is some of the optimism that we've seen surrounding the jobless claims report that came in higher than expected. And I say optimism, at least the market is looking at it as optimism here at this point. Enough here to carry yesterday's momentum into today.
Yeah, it's interesting to see that not only were the jobless claims up, but we also saw a revision of last week's numbers up as well. So an indication that we might start to see some cracks in the labor market coming in here, but continuing claims were revised down. So that's also something to be monitoring. I'm excited to talk to our guest about which of those two data points he's going to be looking at. We have here Philadelphia Fed President Patrick Harker actually earlier talking about what's going on when it comes to the rate hiking cycle and what the Fed speak is going to be looking like, because we have a lot of Fed speak happening throughout the day. So we're going to talk with Vincent Reinhart, former Fed economist, and Dreyfus and Mellon chief economist as well. Vincent, I mean, a lot of data coming out over the past couple of hours and throughout the week. I was talking about the bifurcation that we're seeing in continuing claims versus initial jobless claims this morning. How much weight do you put into the difference that we're seeing in those two numbers?
Actually, the important part of the claims data is the survey week. You want to get the same survey week as the employment report, because that's the best reading on what the monthly number will be. The other thing is in both series, the best line is the second one where it says 4-week moving average. These are noisy data. You don't want to respond to a 1 week blip. So some smoothing, taking a 4-week average is a little more called for.
Vincent, what do you think the Fed is most likely to do at this point? And we talk about the fact that there's still optimism that we will get that June rate cut. What does that then tell us if we don't get it, the rising risk of recession?
So it's a couple points, and that's exactly the way the Fed's got to frame it. It's balancing of risks, as the chair repeated at his press conference and at Stanford yesterday. If they go too late, they risk a material slowing in activity that's unnecessary. On the other hand, if they go too soon in easing, then they might not get as much disinflation, getting inflation back to their 2% goal. That's the balancing of risk. I think they view that former risk, the one you stated about recession, as lower because economic activity still has pretty strong momentum. Those claims data are still on the low side of historical experience. And we're debating now about an employment report where monthly gains will be plus or minus 200,000. That's still double the run rate that keeps resource use unchanged. So the economy's got some momentum. That's not the near-term worry. Maybe it should be, but it's not theirs. It's not mine for now.
Well, Shauna brought up a great point about the potential of a recession. It makes me think about the potential for maybe a K-shaped recovery, because we saw in the ADP that job switchers were getting 10% wage gains. To what extent do you think that the Federal Reserve is concerned about one group getting a lot better and another group getting a lot worse outcomes when it comes to their personal economies?
So in that regard, Chair Powell's next to last paragraph of every speech or his opening statement of the FOMC answers that question, and that is the Federal Reserve cares about outcomes for the American people. They appreciate that its policy tools have an uneven access and an uneven consequence for people. That's a problem. But I think you go on from there saying it's not a heck of a lot the Federal Reserve can do. It doesn't have much influence on distributional policies. That's a matter for legislatures and the executive branch. Is the Fed concerned about an uneven expansion and possibly an uneven downturn? Sure. Is it concerned about the uneven distribution of wage gains? Yes. Should also be concerned about the uneven distribution of wealth gains. The run-up in equity prices is really only benefiting the top sliver of the American population, and therefore may not distribute throughout the whole economy to provide support to spending. Those are all concerns. However, there aren't concerns that shift from day to day or month to month or quarter to quarter. They're in the background for macro forecasting. And the macro forecast of the Fed right now is the economy retains considerable momentum, resources are stretched, and inflation is stubborn on the way down.
Vincent, what do you think that last mile in terms of taming inflation? It's going to be tough. We were just talking to our head of news, Miles Udland, last hour, just about the fact that the Fed has a housing issue when it comes to inflation and trying to get the inflation measures back to that 2% target. How bumpy is this last mile in taming inflation going to be?
Oh, sure. Exactly right to talk about housing, but you could broaden it a little to the service component. 70% of the consumption basket is in services, and those service prices are much slower to adjust relative to goods prices. Basically what happened, the short story of the last 5 years is we created a lot of excess demand for goods. Goods prices went way up because they can adjust quickly. Service prices are slowly trying to catch up to where goods prices now are. And that's what makes the last mile in reducing inflation so hard. And what particularly concerns me is the benefit from disinflation. The relatively easy disinflation we got last year was because goods prices stopped rising. They just basically moved sideways to a little bit down, because they made the adjustment already. And that meant they were no longer contributing to inflation, and in fact, pulling it down a lot in the last part of 2023. Not going to happen this year, given all the supply chain disruptions, given that we live in a risky world, given we live in a world where there's a lot of disruption to infrastructure, goods prices could be turned back up. And that means that service prices will still be rising sluggishly, and goods prices will no longer be contributing to slowing inflation. They'll be pushing inflation the other way. So, right to be worried about inflation.
Vincent Reinhart, always great to get your insight. Thanks so much for joining us here this morning. Dreyfus and Mellon's chief economist, also a former Fed economist. Thanks, Vincent.
Thank you.
Well, stocks are climbing higher this morning, snapping the losses that we saw to kick off the second quarter. The S&P 500 had its best start to the year for the first quarter since 2019, up almost 10% since January 1st. Meanwhile, though, there's two large tech companies, Apple and Tesla, that have lagged far behind. To help us break down what went wrong with these two companies and what that tells us here about what's to come in the coming quarter, we've got team coverage for you. Pras Subramanian, Dan Halley here to break it all down. Pras, let's start with you.
Hey, Shani. Yeah, so we focused a lot on Tesla this week with the EV company missing Q1 deliveries by about 46,000 vehicles, an 8.5% drop from last year. But Tesla's problems didn't just begin this week. So far this year, the stock is down over 30%. With interest rates remaining high, many consumers are opting not to purchase big-ticket items, especially with the company slow to spruce up their aging models. Adding in competitors like China rolling out cheaper EV options, and you can start to see why deliveries are down globally. On top of all this, Tesla is currently dealing with an image problem. Many investors have found CEO Elon Musk's attitude and statements to be volatile, to say the least. And a litany of investigations related to Tesla's self-driving systems have made the product less appealing to consumers. Now, investors are looking to that first quarter report on April 23rd for some signs of upside. Dan, I know you've been watching Apple. What's going on over there with them in Cupertino?
Yeah, it has not been a great 2024 for Apple stock so far. It's down almost 12% from the beginning of the year. There's been a few factors that have caused this. It all started at the beginning of the year when three big stock downgrades kicked everything off. Barclays, Piper Sandler, and then Redburn Atlantic, all cutting the company within the first 10 days of 2024 on fears of slowing iPhone sales and the potential for regulatory headwinds. We'll get there in just 1 sec. Then just over a week later, the tech giant was forced to sell a modified version of its latest Apple Watches because of a patent dispute that was over that blood oxygen sensor. Apple then kicked off February with disappointing first quarter results, with sales in China down 13% compared to the year prior, and forecasting a 5% drop in revenue for its upcoming second quarter. By the end of February, Bloomberg reported that Apple ditched its EV project that had been speculating for 10 years. So sayonara to that. In March, on the 4th, the EU slapped Apple with a $2 billion fine over its App Store practices. And then on March 21st, Apple got hit with an antitrust suit from the Department of Justice, alleging the tech giant monopolized the smartphone market. Now we're getting reports that Apple is exploring home robot technology. Investors will be looking out to see how the company is looking to innovate. Maddie?
All right, Dan, thank you so much for that. Really appreciate that breakdown. And also thank you so much, Pras, for your breakdown on that as well. We're going to have all of your markets action ahead, so stay tuned for more. You're watching Yahoo Finance. Stocks are coming back to life this morning after a rough start to the second quarter early this week, with some economic data causing investors to doubt their rate cut views. Fed Chair Jay Powell reversing some of these jitters after he said on Wednesday that he believes inflation is on a, quote, bumpy path down to 2%, and he expects to lower rates at, quote, some point this year. Lots of meh commentary from Jay Powell there. But with earnings season picking back up next week, could we expect company reports to sway market action once again? Joining us to discuss, we have David Leibovitz, JP Morgan, Asset Management Global Market Strategist and Managing Director. David, thank you for being here. I'm curious, with the upcoming restart to earnings season, what you're thinking about what's going to be driving the market more throughout this second quarter here. Is it going to be Fed speak like Jay Powell repeating the bumpy road commentary, or is it going to be the fundamentals when it comes to earnings season?
So I frankly think it's going to be a little bit of both. And we have the employment report coming out this Friday. We have March inflation coming out next week. I think that's very much going to inform Fed speak and Fed messaging in the very short to medium term. I do think, though, that, given if those numbers are in line with what we've seen more broadly over the past 12 months, so a deviation from the hotter inflation prints and the robust labor prints that we saw in the first 2 months of this year, if that gets us a little bit more back on track from an economic perspective, I do think the Fed will signal that, and I think Fed speak will subsequently take a back seat to the earnings, which, when we think about where equity markets are today, they've gone quite far quite quickly. The majority of the gains have, in fact, been driven by multiple expansion, and so any further upside here is really going to be a function of earnings, and if the Fed keeps on saying what they've been saying, we think that earnings will start to matter a bit more here.
What does that upside look like, do you think, David?
Well, so I think it depends on the way that the macro story plays out, because if we find ourselves in an environment that looks kind of Goldilocksy, so pretty solid growth, above trend growth, but inflation that continues to decelerate, the S&P 500 could easily test 5,500. If we see a deceleration in growth and a further disinflation, I think that's going to make upside for the S&P a little bit more challenging. It's important to remember that corporate profits are nominal variables, and so if nominal growth is good, that should help the earnings story. But if we see a slowing in nominal growth, either vis-a-vis softer real activity or further disinflation, that's going to weigh on the profit story, and that's probably going to cap where the benchmark can go.
I wonder, too, what your thoughts are on what we're seeing in terms of movement in bonds with regards to equities. Is the bond market kind of the smarter, older sibling here, and is there a signal happening there that equities need to be listening to, or is it just noise?
So I think that the bond market is the younger sibling that continues to throw tantrums. If you look at implied volatility for the bond market, it's still quite elevated, particularly relative to what we're seeing in equities. And what that really reflects at the end of the day is just this uncertainty, this persistent uncertainty about what's happening with inflation and what that's going to mean for the Federal Reserve. And so if we get a signal on inflation next week that things are kind of back on track, and we hear from the Fed that they are still expecting to ease policy 3 times this year, my view is that will bring bond volatility lower, and bonds will begin to behave a little bit more like they have historically, instead of the kind of twitchy bond market that we've been dealing with for the better part of the past 18 months.
David, what's your base case on cuts?
So I think 2 to 3 cuts this year is reasonable. I think if the data plays out the way the Fed is expecting it to, which again, given their most recent set of forecasts, does not get us to 2% by the end of this year, I think that they will cut rates 3 times. If the data doesn't cooperate, it could end up being more like 2. But I think that this is a Fed that wants to cut rates. They've said that they want to cut rates, and it's really going to take a significant fly in the ointment for them to deviate from that approach.
Let's go with that less likely scenario, though, that you just laid out. If we only get 2 cuts for the remainder or for this year before year end, what's the response, do you think, going to look like in the equity market? Will we see more pressure?
So I don't think that the equity market necessarily cares about when the cuts come. I think that the equity market cares about the fact that the cuts are coming. And so if the Fed signals that, hey, we're going to wait a little bit longer, and that's only going to give us the room to cut policy or ease policy 2 times this year, but we think that we will continue to ease as we move into 2025, I think the equity market will be totally fine with that. I mean, important to recognize that in the most recent summary of economic projections, the way that the Fed was a little bit hawkish was they actually took a rate cut out of their forecast for next year, and that didn't really seem to bother the markets in a significant way. I think the reality here is that 5.25 to 5.5 on Fed funds is indeed restrictive, and what the market wants to see is a Fed that's willing to walk that back a little bit and try to land on a more neutral rate of interest.
David, help us out for non-farm payrolls tomorrow. What do you think is better news for the market, a bigger number or a weaker number in terms of what that does for the Federal Reserve's moves?
So we're focused more on the first derivative as opposed to the headline figures. You know, our expectation is generally aligned with consensus. I think we'll see about 200,000, 215,000 jobs. I think the unemployment rate could indeed edge slightly lower, maybe not all the way back to 3.7, but kind of splitting the difference at 3.8. What we're going to be watching are things like the data on wages, the data on temporary help services, right? Kind of these indicators that give you a better sense of how much pressure is there in the labor market, right? Is wage growth continuing to cool? Is temporary hiring continue to decelerate? That's going to give us a lot of conviction if that's in fact how things play out. That's going to give us a lot of conviction that the labor market is cooling, the path for inflation is in fact lower, and we can continue to expect the Fed to ease policy during the back half of this year. So less focused on the unemployment rate and the payroll figure themselves, more focused on things like wages.
All right, David Lebovitz, great to talk to you here at JP Morgan Asset Management, Managing Director of Global Market Strategies. Thanks so much.
Thank you.
Well, good news for Wayfair this morning as Evercore ISI upgraded the online home retailer to outperform from inline. They also raised their price target to $80 a share. That's up from $65. Now, the analyst team there saying that the hardest part is behind Wayfair, and this comes as the company is implementing some cost-cutting measures that we have covered many times on Yahoo Finance. Also, as revenue has begun to grow yet again. And at the top of this note, Maddie, what stuck out to me was really just the fact that they're upgrading based on fundamentals, and they put it pretty straightforward here in this first line, saying Wayfair is trying to look its best that it has looked in its 10th year as a public company, and they want to be there. Evercore wants to be there for the party when revenues accelerate, and so as a result, they're going to upgrade their stock to outperform at this point.
I love that they say they want to be there for the party, right? Because don't we all, right? But it's interesting that they talk about how a lot of the other home-related stocks in their coverage have already participated in a little bit of the recovery that we're seeing in the housing market. They're seeing that there's not a lot of that upside priced into Wayfair stock. So to your point, indicating in terms of their price target about a 23% upside to this name. But we have to wonder whether or not we're actually going to see that play out because of this bifurcated consumer that we continue to see. Are we going to start to see more upside for, you know, the more pricey home names out there like the Restoration Hardwares of the world, rather than a Wayfair where you have the consumer that's trading down, maybe doing the Drew Barrymore line at Walmart, which I may or may not be participating in.
Oh, I haven't checked out that line yet. I need to. But this also always goes back to the basics, right? When it comes to why they're a little bit more constructive on this name now, why they are seeing some fundamental improvement. A lot of that is based on the fact that Wayfair is also actually going back to the basics, going back to what has worked in the past. They started doing that just about a year and a half ago, starting in 2022. So just around 2 years ago, they began to return to the core, which is a couple of defining principles as Evercore laid out here when it comes to the cost structure, strong execution, also excellent customer service. What had paid off for Wayfair in the past, so a return to that, a refocus on those three principles is enough for Evercore to be a bit more bullish on this name.
Yeah, really good point, Shauna. Well, we're going to continue to cover not just the Wayfair stocks of the world, but much more of your market's action ahead. So stay tuned for more. You're watching Yahoo Finance. Gold is hitting new highs this morning. Investors looking at the trade as they digest a higher for longer interest rate environment. So I'm going to break some of these moves down at the touch here. Interesting to see gold kind of coming off of its highs from this morning. But if we take a look at how it's been performing recently, you see a lot of upside movement. I'm going to actually zoom out a little bit more and look at it over the past month here. You see just a lot of upside coming in for gold here as investors are taking a look at kind of diversification of this as an asset class. Just want to go back to gold here on the touch. And we're starting to see that gold is sort of acting a little bit more like a safe haven trade, more of a risk on environment asset class as opposed to kind of a store of value, which is how gold has traditionally been played in the market. So indicative of kind of traders sort of looking for some more diversification in their portfolios as we kind of suss out what is going on with the macro environment as the Federal Reserve continues to go along its rate cutting path, but we have confusing data coming in, and that might be one of the potential explanations for why we do continue to see gold just absolutely ripping alongside some other commodities, Shauna, in the space, as well as oil about to hit $90 a barrel and silver up on the day as well.
All right, Maddie, let's talk a little bit more about what is driving some of that momentum that you were just talking about within the price of gold. For that, we want to bring in George Milling-Stanley. He's here at the desk with us, State Street Global Advisors Chief Gold Strategist. It's great to talk to you again. So we spoke just about a month ago when you were outlining the fact that as we see this run up in the price of gold, expectations are continually changing here, just in terms of what the Fed is going to do, the impact that that is ultimately going to have on the price of gold. So I'm going to ask you a similar question to what I asked you just about a month ago, but do you think we're still going to trend to the upside here from these levels?
It looks like that way. If you look at the history of gold, then this is exactly the kind of environment in which gold has tended to perform very, very well. You've got macroeconomic issues, the stock market occasionally wobbling. We're not quite sure when Jerome Powell is going to start cutting rates, but he is confident he's going to cut this year. And you've got a geopolitical environment that's also pretty combustible. And all of that put together, I think it's exactly the kind of environment in which I would expect gold to do exactly what it's doing right now.
How much higher do you think it could go?
A good deal, I think. Our bullish case, the team that I'm part of at State Street, we put out our forecasts in December. Our bullish case suggested gold could trade anywhere between 2,200 and 2,400. We're right slap in the middle of that right now, and it's still pretty early in the year. So we're very confident.
Who are you seeing as the kind of audience for gold right now? What does that look like, and does it differ from what we've traditionally seen?
Look, I think you've got a mix always in gold. You've got the long-term strategic asset allocation type purchases. That has been continuing pretty steady all year. And then from time to time, gold develops some momentum, as it has done. You showed that brilliantly on that chart. Gold develops some momentum, and so you bring in the speculative interests as well. That combination, long-term strategic asset allocation plus tactical buying, is going to push the price higher.
When you talk about the action that you've seen in gold, it doesn't sound like it's necessarily surprised you, given the forecast that you came out with at the start of the year. But when you talk about the uncertainty surrounding the Fed, comparing that to the run-ups that we've seen in gold prices in the past, how does what we're seeing today compared to past bullish sentiments here for gold?
I think the real issue is what's going to happen to the dollar. Yeah. If interest rates are going to come down, and that's what Jerome Powell keeps telling us, then the dollar is going to soften. And when the dollar softens, gold tends to do better. So that's really the way that I'm looking at things right now, watching the Fed to see what they're going to do and when they're going to do it. That's almost as important as what they're going to do.
Well, what do you think?
I think they're going to cut rates probably by three cuts this year. Whether they start in June or not, I'm not so confident of that. It may well not be until the second half of the year, but I still think that they're on track for that. Inflation, is still with us. It's come down on the Fed's preferred benchmark. Core personal consumption expenditure has come down from 5.4, but it's still at 2.5, and their target is still 2. That last mile, if I can put it that way, is always the hardest one to do.
George, where are you seeing that opportunity here for investors? Is it buying physical gold? Is there other opportunities out there? And in terms of what would do best in this type of environment, what are you seeing there?
I'm a great believer in liquidity, and I think that gold ETFs have shown a tremendous amount of liquidity since we launched the first one 20 years ago this November. We'll be celebrating that in November. So I think that gold ETFs are probably the best way for people to go, but there's no one way for all investors.
And one final question on that. What is the best way way for investors to be utilizing gold as an investment? Should it be viewed as an inflation hedge, a hedge against the Fed? What's the most effective?
All of the above. What I like to say is that the promise of gold historically for investors has had a dual nature, that over time it can enhance performance and it can always reduce risk. And if anything's giving me protection plus performance, that's an asset I want in my portfolio.
Really helpful. Thank you so much. Really appreciate you joining us. That was George Milling-Stanley, State Street Global Chief Advisors, Chief Gold Strategist, joining us on all things gold and the Fed, of course, as well. We're going to have all of your markets action ahead, so stay tuned for more. You're watching Yahoo Finance.
Jobs in focus this week as fresh ADP data showing that the labor market remains resilient. Private payrolls for March coming in higher than expected. And now investors are turning to Friday's big jobs report. Well, today we are taking a look at a portion of the population that's still struggling to get jobs. 1 in 3 Americans with a criminal record are having trouble re-entering the workforce. And according to JP Morgan Chase, it's sidelining this population is costing the U.S. economy as much as $87 billion each year. JP Morgan, in conjunction with the Second Chance Business Coalition, Business Roundtable, Eaton Corporation, and the Wharton School are co-hosting the second annual Second Chance Month conference. Today, where business leaders, among others, are examining the state of second chance employment and offering strategies for continued growth. Here with more from the conference in Philadelphia, we want to bring in Heather Higginbottom, JP Morgan Chase's Head of Research, Policy, and Insights for Corporate Responsibility. It's great to see you here. Obviously, obviously a very important initiative, a conference that you're holding right now in conjunction with others taking place in Philadelphia. But Heather, just taking a step back, talk to us just about the importance of this initiative and the economic impact it's having, keeping so many of these people sidelined and without a job opportunity.
Well, good morning, and thanks so much for having me. It is astonishing to think that 1 in 3 American adults, people who are employable, have a criminal record, and the very existence of that criminal record serves as a barrier to employment. It keeps people out of the workforce. It costs our economy lots of money. We have a low unemployment rate now. We need these people to be in the job market and working, and it's been a big priority for us, and we're really excited to be here in Philadelphia today, convening business leaders, academics, nonprofits, community organizations to address this challenge.
I'm curious then, Heather, how you're working on kind of measuring the success of these initiatives, because we do often see efforts to kind of reskill and upskill folks, but until we change kind of hiring practices on the other end of things, it's difficult to get those folks placed in corporations. So what is your measurement for the success of this effort looking like?
Well, that's right. We really do need employers to come together. We need community organizations to support the efforts to educate and support employers who are trying to do this work. So, for example, at JPMorgan Chase, 10% of our new hires annually every year since 2019 have been people with criminal records. And that's because we changed our hiring practices. That's because we established partnerships with key organizations in markets where we do a lot of hiring to help educate people on what jobs they're qualified for, how to apply for a role in our firm, and to really raise the awareness of the issue internally for our hiring managers. But we're just one corporation. What we do is important, but what we really need to do is scale those efforts with other employers and other businesses. And that's why we co-founded the Second Chance Business Coalition. It was about bringing those C-suite leaders together and talking about not just a commitment, but how do you fulfill that commitment? So we've now grown the coalition to 50 large businesses. We're thrilled that the National Basketball Association has now joined our efforts. And the convening that we're having today is really about how do you do this work? How do you confront challenges? What partners do you need to do to really make the change?
Heather, talk to us just about the strategy here going forward, raising awareness. Obviously, getting more businesses on board is making a real difference in the long term. Talk to me, though, about the impact that this has in the short term and how quickly you are able to get more of these people who have been struggling to find jobs, help them get placed in their jobs.
Well, it really is about intention and changing policies as employers to make that happen. And once you do that, you can see results very quickly. One of the things that we observed during the pandemic is that we needed quite a lot, after the pandemic, quite a lot of people to re-enter the workforce. And a lot of employers said, we need to expand our pool. And they said, how do we do that? How do we reach these people who have been barred from opportunities? And so we're really, really focused on the best practices and how we can scale that. And we're also focused on changing public policy and reducing some of those barriers that make it so hard for people to navigate this process.
Well, Heather, talk to me about the difficulty of navigating the process, because I know that you've mentioned that accessibility to resources, that particularly for those who've been wrongfully convicted to get that conviction cleared, that's a very difficult and hard to understand, opaque process. So what would you hope to be changed to make that process of clearing convictions a little bit more accessible?
One of the biggest priorities we have is increasing the number of states who have enacted or have passed what we call clean slate legislation. And what that means is that states pass laws and they say after a certain period of time for certain sets of crimes, your record can be expunged. Unfortunately, the process to do so is incredibly lengthy, bureaucratic, time-consuming, and expensive. And even in those states where there has been efforts to enact these expungement opportunities, it isn't taken up. There's a very, very low take-up rate. What the clean slate legislation does is automate that process so that you don't have to go through an expensive, burdensome, bureaucratic process to do that. And that enables people to overcome a huge barrier to employment. And Philadelphia, we're here today, and Pennsylvania was the first state in the country to enact that legislation. We've seen other states do the same, and we're going to continue to support those efforts across the country.
Heather Higginbottom, we really appreciate you taking the time on a very busy day that you have right now. JPMorgan Chase is Head of Research Policy and Insights for Corporate Responsibility. Thanks, Heather.
Thank you.
Well, Amazon is cutting hundreds of jobs in its AWS cloud division, mostly affecting sales and marketing employees, as well as the team developing their, quote, just walk out store technology. Now, this comes on the heels of the company announcing that they are going to invest another $2.75 billion in the AI research and security company Anthropic. Yahoo Finance's tech reporter Dan Halley has more on that for us. Dan.
That's right, Shauna. We're here with Amazon AI VP Matt Wood. He's here to talk to us about what else? Generative AI and Anthropic, obviously. We have the Anthropic and AWS logos back here. So, Matt, what can you tell us about the Anthropic deal? I know that Amazon completed the $4 billion investment. What does that do for Amazon and AWS?
Sure. Thanks for having me. Yeah, we're a big fan of Anthropic. We just, as you say, just completed our $4 billion investment. It's an equity investment, convertible note. We don't have a role on the board or anything like that. But Anthropic make generative AI what they call foundation models. And that's really the central robotic core for the generative AI revolution. Anthropic today have the best performing generative AI model. It's called Claude 3. We make that available on AWS, and customers build on top of that model to do document management and drive automation and digital transformation inside their organization.
So what are you seeing from customers as far as uptake when it comes to generative AI? Are they clamoring for it? Are they tepidly stepping into it? Are they, going full bore?
There is nothing tepid about generative AI today. I've been at Amazon now for nearly 15 years, and I have never seen such enthusiasm, momentum, and investment from our customers around a technology. And the opportunity for them is really to be able to just completely reimagine core elements of their business, core elements of their customer experience, and to design and deliver entirely new categories of products. And we're seeing that just across the board in so many different industries. Of interest, there's just a huge amount of momentum in the regulated industries. Industries that maybe don't always have the best reputation for investing in new technologies, healthcare, insurance, financial services, life sciences, they are all over generative AI and using it to develop new approaches, everything from chatbots all the way through to Pfizer delivering new cancer targets.
So what are they asking for when they come to AWS and they say, we're interested in generative AI? What's kind of that process, and is there anything in particular that every company is saying, we want that?
Yeah, I mean, the number one thing, do not pass go, do not collect $200, is privacy and security. And what we've heard from customers is that they don't want to have to make a choice when it comes to privacy and security of their data when using generative AI. And our approach at AWS is that customers want nothing more, but also nothing less than they get from any other AWS service when it comes to privacy and security. And that allows them to be able to safely and securely, privately, to be able to use their own data from within their own organization with these foundation models in a way that that information is not exfiltrated, it's not used to train the underlying systems, there's no humans reviewing it. With AWS, they have confidence to be able to bring a lot of that data, which is already on AWS, into their generative AI system, which allows them to build more sophisticated automation.
So in addition to Anthropic, there's tons of generative AI models out there, right? The foundation models. What does Amazon offer in particular when it comes to AWS? We've heard, Google's got XYZ. They're also an Anthropic investor. Microsoft, obviously, and OpenAI are basically best friends at this point. Where's AWS, and what are they offering in addition to Anthropic's?
Yeah, so our approach is that we have our own Amazon foundation models. They're great for building automation and natural language tasks. But what we've seen is that there's not really one model to rule them all when it comes to generative AI. Customers want a choice of models so they can find the right choice in terms of capability or price or latency and speed. And so we offer a range of different models from different providers, some from Amazon, some from Anthropic. We just announced yesterday that we're bringing the latest Mistral AI models called Mistral Large to AWS. We have publicly available models from Meta. We work with Stability AI, AI21 Labs. The list goes on. And so it's really all about helping customers in isolation find the right model for their use case. And then the superpower of generative AI is combining those models and having a compounding effect on the intelligence that you can apply to automation.
Just one last question. The hardware side of things is always very popular to talk about. NVIDIA is one of the biggest stocks of the year and last year.
what kind of hardware can people expect, and are they able to select between them? Can they say, I want to use Amazon's own chips, I want to use NVIDIA chips, I want to use someone else's?
Absolutely. Just like we approach different models and having selection and choice, that is just disproportionately important with the chips and the silicon that customers run on as well. So we have our own chips that we build inside Amazon, one that's specifically designed to accelerate machine learning and AI model training, one which is designed to accelerate model inference or making predictions, generating text, those sorts of things. But customers can also choose the latest NVIDIA GPUs and other accelerators from other providers. So having that choice when it's early like this is disproportionately important, but we think that choice is going to remain important, as more and more customers go further down their journey.
All right, Matt Wood, VP of AI at AWS, thank you so much for joining us. Shauna, back to you.
And Hallie, thanks so much, and of course our thanks to Matt as well. Well, coming up right here on Yahoo Finance, we've got much more of your market action ahead. Again, just about an hour and 50 minutes into today's trading day. You're looking at green still across the screen with the NASDAQ, the outperformer, the three major averages. We'll be right back. Coinbase securing registration as a restricted dealer in Canada today. This means that the crypto exchange is meeting regulators' requirements for crypto asset dealings and can operate legally within the country. This comes as Coinbase is facing a regulatory crackdown here in the U.S. To break all this down and what this means for the crypto industry at large, we want to bring in Faryar Shahzad. He is Coinbase's chief Policy Officer. Faryar, it's great to see you again. So just to make it clear, you now have two entities in Canada. You have Coinbase Canada with an international dealer's license, and then you also have Coinbase right now registered as a restricted dealer. Talk to me just about the headline news of today and how big of a boost do you see this being for your platform and crypto adoption?
Oh, it's a really exciting development. Canada's a very sophisticated market. The adoption of crypto across the population has been enormous. And like in every other market, Coinbase is very committed to being a compliant, regulated market player and working closely with the Ontario Securities Commission and the Canadian Securities Administrators. We're really pleased to have been able to get over this really important threshold and now be able to operate in this market with regulatory clarity and give our customers the confidence they need to transact. So huge development, really important, and we're excited to be here.
Faryar, to what extent do you and your colleagues anticipate today's news coming out of Canada moving the needle in other jurisdictions, particularly thinking about here in the U.S.?
Well, unfortunately, the U.S. has been an outlier. Most of the G20, 80+% of the G20 and major market economies are moving pretty aggressively towards adopting pretty clear regulatory frameworks around crypto. So most of the financial centers and most of the major economies, the EU, UK, Hong Kong, Australia, Singapore, Brazil, and now Canada. So the rest of the world has accepted and is adopting tokenization, integrating it into the financial system, very much with a view towards serving the interests of the consumer. And the US, we're on a bit of a slower track, and I think that's really one of our big headline messages, that the US really needs to get going, both on stablecoin regulation as well as the regulation of the broader market structure. And I think that'll allow the industry to the US to grow and develop and for consumers to get the protections they deserve.
Speaking of regulations or a pathway here forward, next week on Tuesday, April 9th, we know that the Senate Banking Committee has a hearing scheduled right now on countering illicit finance, terrorism, and sanctions evasion. Talk to us just about what you're hearing from policymakers right now and how confident you are that we are going to see some movement on this front.
There's a lot of momentum behind a stablecoin bill, and we're hoping next week's hearing in front of the Senate Banking Committee will hopefully be the catalyst to finally get that commitment to get something done into a real sort of legislative vehicle that we can see to create a clear federal framework around stablecoin issuance in the United States. 98% of the stablecoin market is dollar denominated. The center of stablecoin issuance should be in the United States. Legislation would help make sure that happens, and we hope that Congress moves. So hearings are useful, but legislation is ultimately what needs to happen. The administration says they want legislation. Members of Congress in both houses, Democrats and Republicans, say they want legislation. And I think we're way overdue to actually get some bills done, and we're excited to be a part of the process.
And I know that part of that process is happening right now with the SEC. Having said that, last week, as you know, March 27th, this ruling in the U.S. that will allow the majority of the SEC claims to proceed against Coinbase with $1 billion at stake for the firm. How confident are you that Coinbase can win in this legislation moving forward despite that setback last week?
Where our goal as a company, and Brian Armstrong has said this all along, has been to get regulatory clarity. We can get that clarity in the courts, or we can get it legislatively. I spend a lot of time with members of Congress and with officials from the administration. It's just a matter of, it's not a matter of if, it's just a matter of when. There is a chance, as I said, that we could get a stablecoin bill, even in the matter of the next few weeks or months, potentially. That's a long shot, but it could happen. And I think we'll see, for sure, important movement in the House on a market structure bill. And so legislation's hard. It's designed to be hard in the United States. And I think every step that we take is helpful in that regard. And I think we'll take some really important steps over the next few months. There's 52 million Americans who own crypto. They deserve the protection of legislation and regulation. And hopefully Congress and the administration will step up and provide that to them.
There was a recent poll conducted by Paradigm, the crypto investment firm, asking voters whether or not former President Trump or President Joe Biden would be better for the crypto landscape if they were elected in 2024. I'm curious, do you think either Biden versus Trump would be better for crypto? And if so, why?
Well, I think this whole election season's been great for crypto. You've had so many candidates who look around, see that there are 52 million Americans who own crypto, that they deserve to be treated with respect, to have a clear federal rule so that you don't have the overreach of regulators like the SEC coming after them. And you've seen candidates from all sides of the political spectrum, Democrats, Republicans, step up. The presidential candidates haven't spoken that much about it. RFK Jr. has. A number of the Republicans in the primary did in very forward-leaning ways. And we're hoping over the next few months we'll see President Biden and President Trump both take the opportunity and connect with the 50 million Americans who own crypto and let them know that their agenda is on top of mind for them. And I think that would be a really important political development.
Faryar Shirzad, we always appreciate you taking the time to join us here at Yahoo Finance, Coinbase's Chief Policy Officer. Thanks.
Thanks for having me on.
Let's do a final check of the markets. 90 minutes into the trading day, you're still looking at gains across the board. The Dow now up 176 points. You've got the S&P up just around 0.6%. The NASDAQ, the outperformer of the three major averages. Well, coming up, our brand new show, Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned. We'll see you tomorrow.
Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. On today's show, tax season crunch time. We'll reveal the 3 biggest mistakes that could affect your tax return. And is a 4-day work week for you? It's for me. We dig into the pros and cons, plus the final days of March Madness. Yeah, it is, because we're in April. We have tips and tricks to avoid losing your shirt while you wager. Let's get this bread. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Your wealth theme for today? Bingo, protecting your finances. From mistakes that will cost you on your tax return to tips on sports betting, we'll look at how to safeguard your money. This tax season, Americans are finding themselves with a few extra dollars to spend. The average refund amount is up 6% year over year to $3,081. That's according to the IRS. So, what retailers are expected to benefit from this slight boost? Yahoo Finance's own Brooke DePalma standing by in the newsroom with the deets on this one. Brooke, what do we know?
Good morning, Brad. Well, CFRA analyst Arun Sundaram said this could give a slight boost to discount retailers. Think Walmart, think Dollar Tree, think Dollar General. You see, tax refunds typically have a greater impact on lower income families who may use this extra cash for value everyday essentials. And JP Morgan analyst Christopher Horvez said in a note that auto retailers and other retailers with higher exposure to those low income shoppers could have seen a boost at the end of the first quarter. And he pointed to a few key auto retailers here like AutoZone, O'Reilly Automotive, and Advance Auto Parts, plus sporting goods stores like Dick's Sporting Good and Academy Sports and Outdoors could have seen a boost as well. And S&P Global Intelligence economist Michael Zindenik said some consumers may actually opt to buy a large durable purchase with those tax refunds. Think like a new dishwasher or refrigerator, maybe something they've been holding off for quite some time, and that can lift home improvement retailers like Lowe's and Home Depot. And something else worth noting here, tax refunds were actually distributed so far this year. They're actually down 2% or $3 billion compared to last year. And there are two reasons here behind that. The tax filing period started a week later this year. And get this, people are actually filing their taxes later compared to before the pandemic. So as consumers wait for those refunds, retailers may also see any change in consumer behavior patterns or spending patterns rather this month, April, and in May as well.
It's really interesting, Brooke. Are there any companies that likely won't see a difference though?
Yeah, Brad. Well, those that cater to higher income consumers like Costco, that's a membership model, so they likely won't see a difference there. And stores that cater solely to groceries, so think like a Kroger, that won't see a significant change because consumers are still going there for their everyday goods. But also keep in mind on this, many Americans may not choose to splurge and go all out on spending with their tax returns. Others will make the choice to pay off some debt with those refunds. And right now, U.S. household debt is up $604 billion year over year from credit card, mortgage, auto loan, and student loan debt. And let's say they do pay off some of that debt in Q2. Well, then we could see those consumers want to splurge on goods in the third quarter of this year with that cash left over. We'll keep a close look on it. Back to you, Brad.
That's a really good point on the grocery store front, Brooke. It's not like anybody's going to get their tax refund in the mail and go from buying one box of Uncrustables to saying, you know what, I got this refund, now I'm going to buy 16 boxes of Uncrustables and live like a king or queen. Brooke, thanks so much for breaking this down for us. Appreciate it. All right, everyone, listen up. We're less than 2 weeks away from the deadline millions of taxpayers dread. If you've submitted your 2023 tax return to the IRS, give yourself a big old pat on the back. But if you haven't, you still have until April 15th to do so. Filing your taxes may seem straightforward, but you'll be surprised how many people make common mistakes that end up costing them. So, how can we avoid these issues? Let's get some help here. Dan Geltrude, Geltrude & Company founder, joining us here today. Okay, Dan, what is the top mistake that you see most frequently?
So there's really three of them, Brad, right? And they're so easy and so avoidable, yet they happen all the time. First of all, people end up putting down the wrong Social Security number. Primarily, they'll transpose numbers. That's the first thing. The second thing is they make a mistake related to their filing status. They may be married and they put single instead. No good. And the last thing here is that the information on the return is actually incomplete. Specifically, people have a tendency to forget about some of those 1099s that they got, or they lost them. But any of those three items is going to bring attention to your tax return. And one of the keys about filing your tax return is you don't want to hear from the IRS. You don't want to invite them to the party. And when you make these common mistakes, you're sending that big old invitation right over to them.
Okay, so how can people make sure that they don't make these mistakes and avoid these pitfalls? What are some of the checks, the balances that they can put in place?
Well, the first thing to do is to check your current year tax return against last year. See, if you got your tax return right last year, well, that's a good model to follow to make sure that you didn't make any of those mistakes. Second thing is you want to make sure that you're properly organized with all your tax documents to make sure that you're not going to misplace anything. And the other thing is to make sure you review your tax return very, very carefully before you actually submit it.
Dan, what happens when you file your tax return and you owe, but perhaps can't afford to pay immediately?
Well, that's a big uh-oh, right, Brad? So listen, the first thing that people think is, oh no, I don't have enough to pay my tax bill. I'm not going to file my tax return. Wrong answer. File the tax return, make whatever payment you can, and even if you can't make any payment, file it anyway, because it's all about reducing the potential for penalties for non-filing. Then the next thing to do is look at Form 9465, which is an installment agreement. In other words, try to work out a payment plan with the IRS to get those taxes paid. And then the last thing is what's called an offer in compromise. And that's where you make a lump sum payment for some lesser amount to try to call it even Steven with the IRS.
What about for gig workers out there, Dan? I mean, there have been so many changes within the last year, and I know we're specifically looking at 2023 here as people are filing. Are there significant changes that gig workers should be on the lookout for and how they're filing?
Well, not necessarily changes, but one thing that's overlooked, Brad, is that when you have these gig workers who are receiving 1099s in terms of working as an independent contractor, you don't necessarily have to just put that number on your tax return. You can go to what's called a Schedule C, which is basically the equivalent of having your own business. And by setting it up that way, Brad, you are able to take deductions for any expenses that you have related to generating that income. So what you want to do is make sure that you maintain all the documents related to having expenses for that gig that you have running. That way you can get the benefit of deductions you normally wouldn't get as a W-2 employee.
Dan, how far are we away from generative AI just absolutely changing the entire landscape of filing these tax returns and going through the year in, year out duty and making sure that you're getting your refund or making sure that you're just allocating for what maybe you didn't pay over the course of the year and have to declare as well?
Well, we're kind of there now. I mean, with the advancement of the tax preparation programs in terms of just being able to comply with filing your tax return, yeah, I mean, it's going to go further and further down that road. Where the benefit comes in terms of having human involvement is related to the strategy. How do you legally minimize how much tax you pay? And I don't think that we're there with AI right now. Is that something way down the road? Sure, that's possible. But in terms of compliance, there's a lot out there already.
Dan, always a pleasure to get some time with you. Thanks so much for joining us here on Wealth. Dan Geltrude, who's the Geltrude & Company founder.
Thanks, Brad.
Absolutely. Coming up is Thursday, the new Friday. We'll break down the pros and cons of a 4-day work week. Plus, we're going to dig into more financial literacy tips as we kick off April, also known as Financial Literacy Awareness Month. That is after the break. The future of work continues to evolve, and the hours spent on the job may possibly change too. Senator Bernie Sanders recently proposing a bill to cut the work week to 32 hours without cutting pay. He cites 60% of Americans living paycheck to paycheck, and that since 1973, weekly wages for the average American worker have actually gone down after adjusting for inflation. He says that tech advancements like AI are already boosting productivity and companies' bottom lines as well. So workers should reap the benefits too. Let's bring in Yahoo Finance's Rochelle Akufo to break it down for us. Hey, Rochelle.
Hey, Brad, good to see you. So, as we're talking about here, this is the 32-hour Work Week Act that Senator Sanders is proposing. Now, this would bring the work week down essentially from 40 hours to 32 hours, but it's not as straightforward as just chopping off a day. This is something that would transition over the period of 4 years, and it would be by lowering the threshold for overtime compensation for non-exempt employees. It would also require overtime pay at time and a half for workdays longer than the traditional 8 hours, and at double a worker's regular pay for workdays longer than 12 hours. It would also protect workers' pay and benefits to ensure that a reduction in the work week does not cause a loss in pay. So certainly some juggling that they'll have to do here. But obviously, this is something that isn't completely new. The U.S. wouldn't be the first country to try and attempt this, Brad.
Right. So other countries have already been experimenting with this and versions of this. Or, I mean, if you go to Spain, they essentially just take a massive break in the middle of the day anyway. But I digress. Could the U.S. realistically follow suit here?
Well, as you mentioned there's different ways of experimenting with this version. For example, some of the countries that Senator Sanders cited, France has a 35-hour work week. Now, that's 7 hours a day for 5 days, but they are also exploring a 32-hour work week. You have countries like Norway and Denmark that have a 37.5-hour work week with a 30-minute break. But you also have individual companies, and not just the ones that you see on the screen here, but even within the US, Canada, Britain, Spain, Portugal, and others, they're also piloting studies here. And a global study from Boston College showed that some of these participating companies saw increased productivity, reduced worker burnout, lower childcare costs, and of course less carbon emissions. You figure less traveling, you need less childcare if you're also able to have a bit more flexibility. It is worth keeping in mind, though, that it is easier for certain industries to replicate this success and adjust than others. Of course, as we learned from the COVID pandemic, some people did still have to work in person, especially in some of these hands-on industries. But one of the criticisms, including from the GOP Senator Bill Cassidy, is that smaller businesses are already struggling to find the skilled workers that they need in the US. So to have an even shorter work week with the same pay would hit some of their already razor-thin margins, Brad.
So why now? I wonder how this is going to move forward, but also just the timing of it.
It's true. I mean, look, when you look at every time that we talk about earnings, we talk about how some of these companies are really just soaring. But Sanders noted that he's highlighting this is not the same workforce that we were in back in the 1940s when the Fair Labor Act established the 40-hour work week. In fact, the St. Louis Fed shows that business productivity is actually up 400% since then. And the Economic Policy Institute found that as of 2021, CEOs were paid about 400 times more than the typical worker. And as we mentioned, advancements in AI and other tech should mean that workers are able to stay even more productive while reducing hours. Now, interestingly, this is supported by several unions, including the United Auto Workers. Of course, we continue to see that union push still in 2024. But still going to be a hard sell in Congress, especially in an election year. And of course, persistent inflation. People still feeling the bite, especially small businesses as well. So you are more likely to see individual companies perhaps taking the lead here, depending on how tight the job market remains. So perhaps in your next company meeting, if someone asks if there are any questions, maybe throw the idea of a 32-hour work week out there. But of course, have those productivity numbers out there to back it up as well, Brad.
Yeah, just toss it on the table, run away, and just see what you come back to on the conversation on the other side. Maybe it will be productive. Rochelle, thanks so much. We appreciate it. Well, April is Financial Literacy Month, which places a spotlight on the basics of banking, investing, and how to manage your money so that we all collectively are educated enough to feel stable and secure. But the Federal Reserve, they found a striking disparity in how confident men and women feel with their own money. 54% of women answered a lower percentage of financial literacy questions correctly compared to the 66% of men answering the same questions. Let's bring in to discuss this a little bit more and how we can really close that gap here. Vital Alat-Rachel, who is joining us, and Sorbet co-founder and CEO. Thanks so much for taking the time here. First and foremost, you hear a stat like that. What needs to change in how we're educating people broadly and making sure that we're also closing that gap?
Well, I think, first of all, it's not just a gender issue. Generally speaking, about 55% of Americans say that they're scared to look into their bank account. By nature, there's always a little bit of a gap between men and women as well. And so a lot of it should change on the educational level. But I think people, are a lot more scared than there actually should be. It's not that scared. And there are baby steps that you can take to kind of, regain agency and empower yourself to take control over your finances.
Some of the tips that you have out there include resetting your budget for today's prices. So adjusting your own spending habits for inflation, perhaps, is the best way we can summarize it here. How can people put that into motion and leverage some of the new financial literacy terms they may use and learn during April in order to adequately do so?
Well, one thing is first to recognize that things are a little bit more expensive now than they used to be. And it's about being a little bit more conscious about things that you are, kind of habitually are consuming, but their prices may have changed in the last few months. And we're definitely all feeling it in our pockets. So monitoring that and not going on autopilot and looking into things like subscriptions or things that you have on auto pay and making sure that, these don't creep up on you and they haven't become a lot more expensive than you were used to in the past.
I wonder, and we're going to do a roundup throughout the entire month. Just got this idea. It's fresh. Haven't even told the producers yet. So we're starting here, Vital. Your favorite term that people should remember over the course of Financial Awareness and Literacy Month?
I think one of my favorite hacks is telling people to look into their and benefits that they receive from their employers. A lot of people are not aware of that, but in your benefits package in your work, there's a lot of hidden cash. And in fact, one of my favorite hacks is looking into your pay time off. You kind of touched on that in your previous segment, but people across the US get a substantial amount of pay time off paid by their employer. They actually don't end up using it. And we're kind of programmed to think about it in terms of vacation days we can take, but those are actually worth dollars and cents. And that's a really interesting hack that I would recommend people look into.
Certainly. And as we think about the therapy that's involved for yourself as well, and we're looking at some of the fast stats on Sorbet, your company here, amazing work that you have been able to put forth here. Where do you see and envision people being able to be their own financial therapists along the way as well? Because the mentality needs to shift if you're going to see a concerted effort really pay off for an extended period of time.
So a lot of it is awareness and education, and people are intimidated by it, as we said before, even looking into their bank account. But it's as simple as looking, right? Go into your bank account, look at your last few statements. Understand what you're spending money on. It's not that complicated. People feel like they need to be super financial sophisticated. It's not really that complicated. Look into your last few months, understand what you're spending on, understand things that may have become more expensive, as we said before. Read your employee handbook, understand your employee benefits. It's not that complicated. Start by just educating yourself. That's the first step. A lot of things will become a lot easier once you understand what you have and where you are, and then taking steps to improve on that will come very easily thereafter.
Vital Alat-Rachel joining us here today. Thanks so much for taking the time. Sorbet co-founder and CEO. Look forward to checking back in the future as well.
Thank you so much for having me.
Certainly. Coming up next, everyone, higher for longer interest rates. We break down why it might not be so bad right after the break. By now, we've all heard higher for longer, meaning interest rates for credit cards, mortgages, loans, anything that requires you to borrow money has a higher interest rate for the foreseeable future. But in the background, get this, there's an entire secondary market packaging up loans and selling them to investors, which means a lower interest rate for you. That's called debt securitization. Packaging debts into a single security to be sold to investors. To put it simply, if a bunch of my friends owe me some cash, I can bundle up the amount that they owe me, which spreads out the risk from my reliable and less reliable friends, and sell it to investors as a security, which is a fungible and tradable financial instrument used to raise capital in public and private markets. So the win for traders, a new lower risk investment, and borrowers get a lower interest rate. To break down what this all means for you and your loans, we've brought in the specialist here, Michael Bright, Structured Finance Association CEO, here with us. Mike, first and foremost, why is this something that is in the markets? Why is this also beneficial to those who are seeking a loan?
Well, thanks for having me. Enjoy speaking with you and your audience. I got to tell you, I think you did a pretty good job just now. I'm not so sure you need me here today to talk about this. But,
we need you, Mike. Don't go anywhere. Don't go anywhere.
No, you basically captured it. So, but without securitization, without the structured finance industry, essentially, if you need a loan for whether it be a car or a credit card or a mortgage, you have to go to a bank, and the bank makes an individual decision just for you, and then that loan would sit on a bank's balance sheet. And that's what we had in our economy really up until the Great Depression. And some countries that are developing still have that as well. But with the bond market being part of the equation, the securitization and structured finance industry being part of the equation, your mortgage may be owned by the Bank of Japan, it may be owned by oil money in the Middle East. And that what that does is that brings all this global capital to bear so that when you need to get access to credit for whatever it is you're attempting to borrow to purchase, you're not just relying on one or two banks to do it. The banks are actually facilitators of making you that loan, but then bundling that loan, putting it into a bond, and then selling it off to an investor globally. So now you have global capital that comes in that you can that can be borrowed, and those investors can really model it using statistics because you have a large sample size.
So how does this impact things like credit card rates?
Without this, rates would be higher than they are right now, and they'd be more volatile. So if you don't have the securitization industry, and if you don't have these types of bonds that can trade globally, you have something that's called procyclicality with lending. So that means when the economy's good, banks are very willing to lend. If the economy slows down a little bit, banks pull back quite a bit. And so you see a lot of volatility, not only in the rate itself, but whether or not you can even actually access credit under older systems. If you have a global system where you have tens of trillions of dollars of investment money that can all facilitate lending to communities across the country, you have less volatility, net rates are lower than they would be. Now, I know you were talking about higher for longer and the Fed having to increase interest rates, and that's true, but still by historical standards, we're still quite low.
So it's interesting, when you've got a secondary market like this, some people might think about the Big Short and ultimately how we avert that reoccurring once again here, especially with us having we've been staring down a recession with a likelihood of a recession for about 18 months, maybe even 2 years at this juncture, and still waiting for it to potentially happen, even though we see resiliency continuing to shine through. So all of that considered, how do we avert that happening with the secondary market like this?
Yeah, so no matter how big the secondary market is, no matter how much global capital there is, no matter how much statistics you use, if the loan that's made at the front end is a bad loan, whether the underwriting wasn't done properly, someone was sold a loan that they probably shouldn't have been sold, couldn't afford, fraud, people flipping houses, all of these things that occurred in the years leading up to the great financial crisis of 2008 and 2009. No matter how much global capital is there and how much statistics you use, if the loans themselves are not good, then it's all going to break down, and that's exactly what we saw. The good news is Congress passed some very meaningful reforms in the wake of the financial crisis. And so now there's a lot more safeguards on what you need to do before you can give a borrower a loan to make sure that they can actually afford to repay it.
What is the best way that borrowers can take advantage of or maximize their potential loan or even their profile, their worthiness in the secondary market and with the securitization that takes place?
Absolutely. So borrowers should be aware what their credit score is. This is a very important data input into lending. So one of the very first things that people will look at is how much money do you have, how much access to credit do you have, and what's your credit score. There are various companies that can provide you your credit score. There's lots of commercials for it. Be aware of your credit score. Pay your bills on time as much as you can. It's okay, of course, to use a credit card. I do. We all do. It's good to have a mortgage loan if you need. It's okay to have an auto loan if you need. These things are available to you. But the more you can pay on time, the higher your credit score. So by borrowing and paying that money back on time, your credit score goes up and makes it easier to borrow. If you get yourself in a situation where you're not able to pay your bills regularly or on time, that can impact your credit score, and then that gets put into all the modeling, and that determines whether or not you can get a loan, and if so, at what rate.
Michael, just lastly, while we have you here, bundled security. A lot of people might see that, hear that, and say, I don't know what the heck that is. Even though we've just broken down what debt securitization is, within debt securitization, what is a bundled security?
Well, basically, it is, like I said, you did a good job, I think, at the very beginning. So if you take a bunch of loans that are all very similar looking, so a bunch of borrowers who have similar, let's say, credit profiles, similar employment history, similar income, similar amounts of debt, you have no idea if there will be a life event for one of those particular borrowers. Things happen. Things that are anomalous happen. But if you put them all together, if you just think back to sort of basic statistics, you have a bell curve that happens, and you can manage averages and use the statistics to make predictive behavioral outcomes, but you need enough of the input in order to do that. So the more loans you put together into a bundle, the more likely you'll be able to use models to predict behavior of those borrowers, whether it be that they're going to prepay their loan or that they may have a life event that could lead to a default. When you have all of that stuff bundled together and you can model very well, and there's a whole world of data out there that the industry, Wall Street, and global investors use for doing that. Once you have that, then it just makes it easier to facilitate that credit lending, and then you can do it at a lower rate.
Michael,
so it's really about the pooling.
Yeah. Michael, thanks so much for taking the time here with us today. Really appreciate it. Michael Bright, Structured Finance Association CEO.
Thank you.
Well, coming up, it's the return of the Mac, Ross Mac to be exact. We dive back into Maconomics with today's topic, sports betting. But first, Ross Mac gives us the lowdown on the importance of Friday's jobs report. Take a look.
All right, now, did you know the U.S. economy gets a monthly report card? Yep, and it's called the Jobs Report. And it's released on the first Friday of every month by the Bureau of Labor Statistics to paint a picture of just how good the overall economy is doing. Now look, the primary data points that investors focus on are how many jobs were created, the unemployment rate, and wage growth. Now let me break all that down for you. Now first things first, you got non-farm payrolls, and that's gonna monitor full and part-time job creation while excluding seasonal jobs, like farmers. Now secondly, you got the unemployment rate. Now that's the total number of people in the workforce that don't actually have jobs who are out actively looking for one. And lastly, you got the average hourly earnings or wage rate, and that's gonna measure how much workers earn in each respective industry. Now you gotta ask the question, why does this actually matter? Well, it directly impacts everything from policy decisions in Washington, D.C. to the interest rates on your loans and even the stock market performance. For instance, a surge in employment, that's gonna suggest businesses are booming, possibly leading to higher incomes and overall consumer confidence. But now on the flip side, if unemployment actually ticks up, it might signal economic trouble is ahead. However, when job growth is a little too rapid, it can also signal inflation, possibly affecting everything from your mortgage rate to the cost of your groceries. Look guys, this report gives us valuable insight, and over the long term, as unemployment falls, the stock market, it tends to go higher. It's your boy Ross Mac, and this is Maconomics for Yahoo Finance.
March Madness, the NCAA's college basketball tournament, coming to a close in the next few days with the men's Final Four games on Saturday. That's followed by the championships on Monday. And don't forget about the women's Final Four. That's Friday with their championship on Sunday. Americans expected to bet over $2.7 billion by the end of the tournament. That's double the amount of Super Bowl bets this year, according to the American Gaming Association. If you take a look at my bracket, and here we go, the producer's just airing me out once again here. We can have a little fun on this one, though. How can we, though, have a little fun safely betting on the games without losing our shirts here? Joining me now, we've got Ross Mack, personal finance expert and creator of Macconomics. Ross, I don't know how your bracket looks. Hopefully a little bit better than mine. I don't have any Final Four teams, but I'm enjoying watching the games nonetheless. How can people make sure that they don't overbet?
Well, one, Brad, thanks for having me. Two, my bracket is just as bad. I think I got UConn left, but I got Purdue losing early. But I love the question, right? How can you make sure you don't lose your shirt betting? One, you just got to understand, in order to truly have fun, you should not be using money that you can't afford to lose, right? Do not bet money that you can't afford to lose, because there's an old saying, right? Vegas always wins. And one thing, the biggest thing to really realize is that the moment that you start looking at these parlays, I think we've all seen on social media, someone turning $10 into $250,000, right? Everybody now wants to do it, right? But understand the actual odds of hitting parlays, they go down considerably every time you add a new leg. And by definition, a leg is just another bet on the same exact ticket. So using statistics, right, by having a 10-leg parlay, you're going to have less than a 0.15% chance of winning. By having 5 legs, meaning 5 legs on the same betting slip, you're going to have less than 4% chance of winning. So anytime you actually see someone winning a big parlay bet, just understand that that's marketing. All they're trying to do is get you to find a way to say, okay, let me get your $10. Let me get your $20. For every person that wins that $200,000, there's 200,000 people that just lost $10 trying to replicate the exact same thing. So in order to not lose your shirt, don't bet money you can't afford to lose. And I would recommend, right, I don't never recommend gambling, but if you are to do it and trying to have fun, it's actually best to do single bets.
Interesting. Okay, so what if you're more of an investor than a gambler here? Should you consider buying shares of perhaps a betting company even?
I love the idea, right? I don't own any as of now, but if you are loving the overall kind of FOMO of people starting to sports bet, other states finally legalizing it, then yeah, the answer is yes, right? I would obviously do your own due diligence and look to see which company has more cash, which companies are having more revenue, spending less cash, right? Obviously, anytime you turn on the TV, and when you see an advertisement for it, they're spending a lot of cash. But I think overall, when it's all said and done, you have the ability to, when your friends say, oh, I almost won this parlay, well, guess what? That person is now paying you.
That's right, yeah. Anytime you see JB Smoove pop up in an ad for one of the betting apps, more than likely that means a company is spending heavily on that customer acquisition cost as well here, although very good commercials out there, we will say here, very creative. You know, just lastly, while we have you, how can we make sure that people are investing like an NCAA all-star here?
I love it, right? What I would say is you have to do it automated, right? Take all the guessing work out, find a very safe ETF, right? I always recommend the very first one you buy is the S&P 500. And guess what? Take all the guessing work out. We're all used to paying bills on a monthly basis. How about pay your future self on a monthly basis by setting up automated investing into the S&P 500?
All right, just lastly, who do you got winning?
I got UConn, and for the ladies, I have Southern Carolina.
Oh, okay, all right, South Carolina, we'll see. Great program over there and great program at UConn as well here.
Gamecocks.
There you go. Ross Mack, thanks so much for taking the time.
Thanks for having me.
Good to see you. There's an employer-sponsored account that can help you build wealth that you may qualify for but probably aren't taking advantage of. No, I don't mean your 401k. I mean an HSA, a health savings account. You could be building stacks of tax advantage cash right now. Money that you can grow with the markets to help pay for medical expenses down the line. And here to tell you all about it, we've got Jennifer Streaks, Business Insider, Senior Personal Finance Reporter and Spokesperson. Jennifer, great to see you here. So a lot of people are missing out on this right now. How can they make sure that they are getting into the right and taking advantage of this HSA?
Well, thanks for having me. But yeah, the HSA is a common health plan that most people do not know about. It's through your employer. You just sign up with it the same way you would with your 401k, and you start immediately taking advantage of the tax benefits.
Okay, and so what can you use those HSA dollars for typically?
You should think about it as a bank account for your health, for your medical expenses. It's for qualified medical expenses, things that aren't going to be covered by your regular health insurance plan. And there's a long list. You check to see what your plan will cover, and you can reimburse yourself if you have to come out of pocket for those expenses.
So when should people start investing in an HSA account and making sure that there are funds that are going in there?
As soon as you can. I have one, and I love it. I get to reimburse myself, or if I don't want to reimburse myself, my contributions actually reduce my taxable income. So it's beneficial to me even if I'm not actively using it.
And you mentioned the tax benefit there. What are the typical tax benefits of HSA accounts?
They reduce your taxable income. Your growth, any of the interest that comes out of that account is also tax-free, and your withdrawals are tax-free as long as you use them for qualified medical expenses. So it's a triple tax benefit.
And then the eligibility here, I mean, how do people go about assessing their eligibility to contribute to an HSA?
Well, you have to have a high deductible health plan. So you need to check with your employer, see what your deduction is, look at your plan, the health plan, your number one plan first, and see what your deductible is. And that'll tell you whether or not you're eligible for HSA.
Just lastly, while we have you here, I mean, the dollars that people are putting away, it gets cut into a little bit more as the expenses or the cost of certain services go higher within the healthcare industry as well. How can people adequately assess the amount that they're putting into that spending account?
I think that it depends on what your health needs are going to be over the course of the year. We all know what our well checkups are going to be, what your dental expenses are going to be. And if you need to increase your contributions into that, so you basically make a budget for your health care, and you decide based on that what you're going to need to contribute.
Jennifer Streeks, Business Insider Senior Personal Finance Reporter and Spokesperson. Jennifer, great to see you. Thanks for taking the time.
Thank you.
Certainly. We're nearing the close of the second week of our brand new show, 11 a.m. show here, by the way, Wealth. And we want to show you some of the highlights over the last week. Let's take a quick look. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. From our hand-picked community of experts, take a listen to what they had to say as we got the show off the ground.
I think financial literacy has a stigma. Now you're talking, how do we implement it early on so that it becomes a part of our lives every day? A lot of life, a little bit of money. How do I extend this?
Over half of Americans cite inflation as the greatest obstacle to financial security.
Pay your bills on time. Late payments really ding your credit score.
You've got to reduce your debt. Anything that is going to make you a target of the high interest rate environment, you need to take a second look.
Listen, I think it's so important to make sure that your house is ready for sale. The key thing to remember here, though, Brad, is not to go in debt in order to do so. Try to do these upgrades at the speed of cash.
All things with the keys of the crib there. Appreciate it, Jay.
Thanks, Brad.
I don't feel richer after this segment, Andy. I tell you what, I'm getting up, I'm walking off set.
You're going back to those numbers, and if you're not there, you got to figure out what that number is that you need to hit.
Forget everything you've been told about estate planning. It's not just for the wealthy.
The estate is for those in Beverly Hills. No, you have life insurance, you created an estate.
Planning that early retirement you always dreamed of? Hey, maybe.
If you're one of those people that has not started yet, get started. If you start early enough, invest wisely, and make right and smart financial moves, you can retire much earlier than those preconceived retirement ages that we all think about.
It's really the people in the middle who have to struggle for saving for college and saving for retirement at the same time. Because the last thing you want to do is retire and then think, oh, I've made a mistake.
There is a responsible way to manage coming into a large amount of money.
Longer term, you're thinking about things like gifting, estate tax, asset protection, not just the dollars and cents at this point, but what are your goals and values?
I already know what I'm doing. First and foremost, I'm gonna legally change my government name to first name Bless, last name Highly Favored. An introduction to Maconomics with one of our favorite influencers, Ross Mack.
When it's all said and done, you just got to ask yourself, where's the smart money? The reality is you're looking 5-10 years down the line.
You got to continue to take care of your biggest asset as if you're going to play again on Sunday, because it's going to pay off for you in the long run.
Well, wealth is all about building your wealth, growing your wealth, and maintaining it. And we've got a good one here for you today. Here to discuss everything from how he built up Black Ops basketball all the way to how he's maintaining his own profile and building partnerships on top of that in an age as well where a lot of athletes look up to him because they're trying to figure out how they can do the same. We've got the founder and the owner of Black Ops basketball, Chris Brickley. Chris, great to see you, man.
Thank you. Appreciate you for having me.
Let's start there first and foremost. I mean, walk me through your story here, how you built a brand on your own terms. You were with the Knicks organization at one point. You stepped away. You said, I can do my own thing, and I'll build it up from the ground up.
For sure. I mean, so I was with the Knicks for like 4 seasons. I started off as an intern. Phil Jackson got the job, kind of cleared house, fired everyone, kept me, and gave me like a 3-year contract. And after the first year, I was like, okay, I think I could like leave and start my own business. I didn't necessarily know it was gonna be successful, but I believed in myself. My family was mad at me. Didn't have health insurance. There was nothing guaranteed.
Yeah.
And so, I left, started Black Ops basketball. Year 1, it was shaky. I was like, damn, I don't know if I should have left. But, it always takes some time. I built a team around me. I got a great manager and just got built great. I had great interns. I had a good PR person, and I just grinded. And with the help of my manager, we started signing brand deals, and I became the first trainer to do many things, and it's been a success.
It has been, and by many standards, you really broke the mold for trainers out there to think more about the different streams of income and how that can redefine your own financial comforts that you're able to set in motion. I mean, how did you and your team go about constructing that?
Yeah, so most trainers, you have to rely on the player. So you're constantly asking the player, hitting them with an invoice, and that's not the most comfortable thing to do, especially when you're friends with them. And so I was like, okay, I need to figure out a way to make an income, make some money without having to be like, Carmelo, can I have some money, blah, blah, blah. Even though I know I'm doing the work. So we started hitting up these brands, and it started off with Puma. I was the first trainer with a sneaker deal. I had my own sneaker. I like your Pumas, like some great Pumas right there.
How do you go gremlin status with it?
I like those. So I started, that was the big, that's like the to get a sneaker deal, that's like the main deal. So from there, I started getting Body Armor and Therabody and Google Pixel and Bose and NBA 2K. And so they kept going. It was my manager and I were trying to build an empire.
Absolutely. I mean, in that empire, let's talk about some of those brand partnerships a little bit further. I imagine there's a great deal of young athletes that look at how you were able to build this, how you were able to create success for yourself and say, you know, how do I work towards something like that? And also at the same time, how do you evaluate what a good brand partner is? How do you go about those discussions?
That's a great question. So at first, I was taking any deal I could get, right? So the first deal I think my manager got me was Welch's grape juice. And so it was a $5,000 deal.
Yeah.
I was like, wow, they're paying me $5,000 to an Instagram post. And so I took that. So then fast forward to now, it's like a very in-depth process. Like we're about to do a deal with DoorDash. And why does it make sense? I'll be doing workouts all day. Sometimes I get hungry. Sometimes the player gets hungry. All right, so if after the workout, we can go over to this like machine and order some food, then that works. Why does Therabody work? The players need to recover. Why does Body Armor work? You get thirsty during a workout. So if it works for me and it works for the players, then that's usually a good deal.
What do you think about this entire NIL era right now? I mean, you've got it across sports, across both genders, so men's and women's, and we're seeing that play out in March Madness here too this year.
For sure. Yeah, the NIL thing, I feel like companies are still figuring it out. Some companies, they don't know. So I feel like, well, on the women's side, so to start with the women's and men's thing. So that's 3 NIL, and on the men's side, only 3 players have deals. On the women's side, 15 players have deals.
Wow.
And why is that? Because in men's, they go one and done. You'll be a freshman, then you leave. In women's, you get to see their story play out. Angel Reese comes back, and Caitlin Clark comes back, and does these like real stories. They're there for 4 years, and it's like it's almost, they have a career.
Right.
I think on the men's side, they're there for like 6 months, and they leave. So I think the future of the NIL definitely lays on the women's side, but it's definitely interesting.
You know, it's interesting as we were watching March Madness, you and I were just talking about this before we sat down as well, just how remarkable the women's side of the tournament has been this year to watch right now. You know, just your takeaways from the tournament.
Yeah, Caitlin Clark, I feel like she's taking over basketball as a whole. Everyone's talking about Caitlin Clark over the NBA, over everything. I think it's super interesting. She scored 41 last night, all-time leading scorer in the history of women's basketball. You know, she just signed a huge deal with Nike, so there's billboards of her all over the place. I think it's a big deal. And then I'm not sure if you've seen Ice Cube. He offered her $5 million
to play in the Big Three instead.
Yes, and you know, the WNBA, you get $125,000 for a season. So it's interesting. It's like, what do? Do you take the $5 million? I don't know if you're gonna make $5 million over your whole career in the WNBA, but it's the Big Three. So it's very interesting. Basketball and women's basketball, it's at an interesting point right now.
Because you train a lot of WNBA players as well. I mean, I've seen your workouts with Stewie and Jason Sudeikis as well.
Yeah, for sure.
In the same kind of breath, same workout. And there is still a massive discrepancy and disparity between the men's and the NBA wages and salaries versus the WNBA. Now, the WNBA has been growing in fandom. We've looked at the year-over-year stats.
Yep.
What do you think the next kind of tipping point is as you discuss with players, team owners, people?
Yeah, it's almost like they need to figure out a way to figure out the money standpoint. It's tough you have to think most WNBA players, they play the WNBA season and then they have to go overseas because it's like they don't make enough money just play in the WNBA. So they end up playing 12 months of the year. Their bodies get worn out. And so unless you're like a Breanna Stewart where you can sign brand deals, so you can just play in the or a Sabrina. So that's been some big moments like Sabrina versus Steph in the three-point contest. So women's basketball is definitely, getting more popular.
We're wrapping up today's show. Tune in at 11 a.m. Eastern tomorrow, where we'll dive into the great wealth transfer and the final days of March Madness in the NCAA tournament. We'll bring you our conversation and the other side of this conversation, much more to it, with Chris Brickley, basketball coach and founder and owner of Black Ops Basketball. And we're also going to discuss student athlete compensation. Plus, we reveal what you need to do if you want loan forgiveness this year. That's it for now. I'm Brad Smith. Thanks so much for watching.